This is not simply an AI-driven rally. It's a broad rally.
What we are seeing is the AI momentum continues to move forward.
Were it not for AI, this would be a very, very different story.
You asked me to pick a side right now, I would not own equities.
Just because you're not at 2000 bubble territory doesn't mean you're not in a bubble.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday, looking to snap a three-day losing run. Equity markets bouncing back, heading into Nvidia's quarterly earnings report as Goldman is gearing up to take on a leading role in the biggest IPO of the year. One bank CEO is looking to reassure staff following some very clumsy comments on AI-related layoffs.
Here would be my advice. Know your audience before you go speak to them, whether they're students, whether you're employees, whether you're giving a speech. The Standard Chartered CEO is saying that his remarks were taken out of context. But if you listen to what he said, which we played yesterday, they weren't taken out of context. That is what he equated to in terms of AI. He's talking about, in some cases, lower value human capital will need to be replaced.
Yeah, I'm with you. The context wasn't lost here. No. It wasn't lost at all. In fact, he's not the only one that is struggling to really communicate what they're trying to achieve with AI. We've talked about this repeatedly since the start of the week. The pushback over the weekend to some of the commencement speeches across colleges across this nation. Every time AI was mentioned, there is a real branding, PR, marketing problem around this push.
Unbelievable. The second AI was brought up at a number of commencement speeches. I know Eric Schmidt, the former Google CEO, got a lot of attention, but Jonathan, there was a number of them. One individual brought up AI and said, I know you guys don't like it. Booze, booze, booze. Deal with it. That's what he said to this graduating class, that they're seeing the future and saying, where do I have a place in all of this?
We're going to spend some time on this later in the program. We'll also spend some time on this. Check out the bond market. 2s, 10s, 30s. Yields coming in just a touch. That's a relief given the sell-off we've seen in the last 24 hours and the past few weeks. On a 10-year since last Monday, higher by some 25 basis points this morning, down 3 basis points. On 30s, the highest close we've seen on a 30-year yield going back to 2007. This morning, down a single basis point. It's difficult to put a lid on this because there are a lot of forces building outside of the United States.
Absolutely, a lot of forces. This is a global issue, and of course, a lot of this is being driven by inflation expectations and what is happening in the oil market. And the fact of the matter is, to this day, we still do not have an agreement when it comes to Iran. The president spoke about it yesterday, and he talked about the fact that basically he's going to give Iran 2 or 3 days, maybe Friday, Saturday, Sunday, something maybe early next week, a limited period of time to get to an agreement. I'm reading his quote here, or there's going to potentially be a resumption of strikes.
The headline event a little bit later after the closing bell, of course, full coverage today of what's going to happen with Nvidia this morning in the pre-market, higher by 1.8%. It's had a great run off the lows from the end of March, up by more than 30%. But this has not been the blockbuster story of the last few months in the chip space. That's been Intel. That's been AMD. The gains elsewhere triple the gain we've seen on Nvidia since the March low.
There has been other names that have just done an amazing job. Intel, you have to think, how much money is the U.S. government actually making right now based off their 10% stake? When it comes to Nvidia, though, I think for this, and you lead a lot of the analyst research on this, it's either going to be a green light for the entire market to maybe rip and the AI trade to continue, or it's going to be a red light for those individuals that said, maybe we're just too overexposed, this trade is just overdone, and maybe potentially that's going to be a huge market signal to the downside.
That stock is up in the pre-market. Futures doing better this morning, higher by 0.4% on the S&P 500, following a 3-day losing run over that period, down about 2 percentage points on the S&P. Coming up this hour, we'll catch up with Keith Lerner of Truist as elevated yields weigh on equities, Catherine Thompson of the Cato Institute as President Trump threatens a big hit on Iran, and Angelo Zino of CFRA with Nvidia earnings on deck. We begin this hour with stocks finding a firmer footing following a 3-day losing streak. Keith Lerner of Truist writing rising oil prices and interest rates may finally be starting to stick to what has otherwise been a Teflon market. Keith joins us now for more. Keith, welcome back to the show. It's good to see you, buddy. This market run has been really quite powerful. The rally's been big off the March low. Just walk us through why you think this bull market is still intact.
Yeah, we certainly think the bull market still deserves the benefit of the doubt. That's been our mantra for the last few years. But, early in this month, we talked about this Teflon market. Nothing was bringing it down. We highlighted these risks that we all know about, oil prices and interest rates, which are obviously related, and they have moved up. And, underneath the surface, we've actually seen them bite. Look at retail. The equal weighted discretionary sector is down about 10% from its highs. Retail sector is down about 10% of the highs. The lowest relative performance since the global financial crisis. So we are seeing things bite, but at the headline index level, it's still about AI. And, obviously we're all waiting for the print today. When you think about why markets have actually been somewhat more resilient relative to these headlines, AI is a common theme for large caps, for small caps, for emerging markets as well. And we think that theme is intact, but also probably likely due for a little bit of a rest here.
Well, Keith, let's build on that. The chip sector makes up about 18% of the S&P 500. We've seen a massive rally off the March low, even with the recent correction in names like Intel, in names like AMD. After the close, we hear from Nvidia. Higher in the pre-market, had a nice rally itself, but nothing like the gain we've seen elsewhere. Keith, when you look at that sector at the moment, when I speak to the technical strategists, they say this is stretched, it's overdone. Jonathan Krinsky of BTIG is pointing out he thinks you'll get the equal and opposite correction, which means a lot of downside from here for the chip players. What's the more fundamental argument for these names?
Yeah, I'm encouraged by looking at the markets from both a technical and a fundamental perspective, and they're showing somewhat of divergence between the two because on a 3-year rolling basis, the semiconductors have had the strongest performance since the bubble period. The main difference from the fundamental side is, overall valuations for the semiconductors is around the 25 multiple, about half of what it was in 2000. And then we looked at forward earning estimates since last October. If you recall, October was where the market, or at least the tech sector, had peaked before this recent run. So we've seen this big rise in semiconductors up over 50, 60%, but the forward earning estimates are up 90%. So it's one of those things where I think if I put that together, I do think on a short-term basis, this area is stretched, due for a rest, but the underlying fundamentals are still there. And I think longer term, if we look out over the next, say, 12 to 24 months, I still think there's upside, but I actually think there will be more of a consolidation. And then lastly, John, just not that I'm a stock picker per se, but you look at Nvidia trading at a multiple in the low 20s versus some of those other names that you're talking about, which are up 200% and trading at much higher multiples. So there's also divergence there as well as we talk about the industry.
Keith, one sector that is potentially going to benefit the most from AI is industrials, and you recently downgraded them. Why?
Yeah, we downgraded them last week to neutral, so that's more of a market weight. And there's a couple of different factors. I mean, one, going back to the fundamental side, the valuations for a brief period of time went to about a 25 PE. That was higher than actually the tech sector. But the difference is the overall earnings momentum is somewhat weaker for the sector. The tech earnings momentum is much stronger. And then the relative valuations became the highest level that we've seen in more than a decade. So we just saw expectations moved up quite a bit. And it's also a pretty disparate industry. It's not a pure play. I mean, you have defense on one side, you have more the industrial players on the other side. But overall, so again, more neutral. We still longer term, we've kept our longstanding overweight to tech, we're overweight communications, we're overweight energy. Those three sectors, the commonality is they have the strongest upward earnings revisions in the entire market.
Keith, how are you thinking about this market right now, given the fact that the Strait of Hormuz is still closed? We're 8 minutes into the start of the show. We barely talked about this conflict that exists, which is one of the biggest chokeholds in the world.
Yeah, it's pretty amazing. As you all, and I've spoken to experts in the field, I mean, I think if you would have told them that it was still closed by now and where oil prices would be, we would expect oil prices to be a lot higher. But overall, I think it goes back to this AI theme. Because again, the higher energy prices is biting. I mentioned the consumer discretionary equal weighted sector down 10% and the underperformance there. But if you look at the S&P 500, as we all know, it's 50% tech and tech adjacent. Look at small cap. The small cap indices. A lot of people are saying, hey, why are small caps holding up, relatively well in this environment where more geopolitical uncertainty, higher rates, which is not great for debt. But small cap tech up until recently was up over 40% for the year, trouncing large cap tech as well. So I think all in all, it's still definitely a concern. It also suggests we kind of consolidate. But one thing I want to just point out, when we looked at, these big surges in markets over a 30-day period, like we've had for the S&P up until recently, where you were up more than 15%. After that, the forward returns over the next month, 3 months, kind of mixed. But as you look over the next 12 months, the markets have been up 14 out of 15 times with double-digit gains. So what does that tell us? That just tells us underlying momentum is a good longer-term sign. But again, maybe more due for a rest after such a big run off the lows.
Keith, let's talk about the bond market challenge just briefly. You've alluded to this, you're not alone. Clearly the equity market has the warm comfort blanket of very powerful earnings. I just wonder how insulated it is from this. If we can bring up the bond board and just look at 2s, 10s and 30s, there has been a reset higher in yields with 2s at 4%, 10s at around 460, 30s around 5%, Keith. How insulated is the equity market from this?
Yeah, I think this is where we have to also think about, which equity markets are we talking about? Because, I mean, we have, like I said, seen some damage on the consumer side. Materials stocks are down 6 or 7%. Industrials down about 4%. You're seeing international developed markets underperform, quite a bit as well. So you are getting hit. And the more this goes up, obviously, the more potential pain. But then the question I think about, this dominant AI theme, let's say, especially as these companies raise more debt, how much of a difference is it going to make for the AI theme if yields move up 50 basis points? We're going to see a slowdown in spending? Probably not. So I still think ultimately for the headline indices, it comes down to AI and tech. I think the higher yields definitely maybe compress the overall valuations for the market, but it's not a showstopper. I just think it's another reason why to expect more of a churn here near term after this kind of V-shaped recovery.
Hey, Keith, it's good to see you, as always. Thanks for catching up with us. Keith Lerner of Truist on this equity market. Let's talk about this bond market. So inflation very much in the driving seat at the moment off the back of what's happened in the Middle East. In the UK, downside surprise on CPI, enough to unlock this move at the front end of the UK curve. 2-year gilts this morning, yields low by 10 basis points. Across the curve, you're seeing yields come in. The action, the fireworks further out along the curve, particularly on the 30-year maturity, and you see that worldwide. I'll go through some of the numbers for you. In the US, the 30-year yield, the highest level since 2007. This week in Germany, the highest level since 2011. In the UK, very close to the highest level since 1998. And in Japan, the highest level on record.
It's basically the entire world realizing that there's potentially going to be fiscal pain down the road. They're going to have to spend a lot more money when it comes to these governments. It's a very interesting moment because this week we're going to get a brand new Fed chair, and he is going to have to contend with that bond board.
Sworn in this coming Friday. Looking forward to it. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Good morning. President Donald Trump threatening Iran with a, quote, big hit if a deal is not reached soon. Trump's comments coming just a day after he claimed to call off another attack. Vice President J.D. Vance striking a more positive tone as well, saying progress is being made towards a deal. Lowe's falling pre-market. The home improvement retailer reporting first quarter earnings that beat analyst estimates. Its fiscal year operating margin, though, fell short. Lowe's CEO Marvin Ellison saying the company remains focused on a total home strategy in spite of a challenging housing macro environment. Global chip supply may be at risk after talks between Samsung and its largest labor union collapsed. Workers at the world's biggest memory chip maker are planning a work stoppage tomorrow. The Hospi fell on reports of the strike. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie later on this hour. Up next on the programme, teeing up another big hit on Iran.
They come to the table, they're begging to make a deal. I hope we don't have to do the work, but we may have to give them another big hit.
Up next, we'll catch up with Catherine Thompson of the Cato Institute, live from New York City this morning. Good morning. Coming up in the next few hours, some earnings. These earnings target 6:30 Eastern Time. Later on, TJX at 7:30. A read on retail in America. And after the closing bell, Nvidia after the bell, the headline act a little bit later on this afternoon. Into that, your scores look like this. 3-day losing streak on the S&P over that period, down by about 2% on the benchmark. On the S&P this morning, futures bouncing back by 0.4%. On the Nasdaq, up by 0.7%. Helped out, no doubt, by the fact that Nvidia is positive in the pre-market. Bit of a change in fixed income, some nerves yesterday, settling down just a little bit. 2-year yields down by 3 basis points, 10s down by 3 also, 463.93, and your 30-year coming off the back of the biggest close we've seen, the highest close we've seen on a 30-year yield, going back to 2007, yields down by a single basis point, 516.48. That's the bond market picture. Let's turn to commodities. Crude, Brent down by some 2%, Brent 109 and WTI at around 102. Under surveillance this morning, teeing up another big hit on Iran.
So they called up. They had heard I made the decision. They said, sir, could you give us a couple of more days? I'm saying 2 or 3 days, maybe Friday, Saturday, Sunday, something, maybe early next week. I hope we don't have to do the work, but we may have to give them another big hit.
So here's the latest this morning. President Donald Trump warning of fresh strikes on Iran in the coming days as the White House pushes Tehran to return to the negotiating table. Joining us from Washington, Bloomberg's Tyler Kendall. Hey, Tyler.
Hey, John. Good morning. Well, President Trump says that he will only wait a, quote, limited amount of time for Iran to come to the negotiating table. As you heard, he outlined that could be 2 to 3 days or early next week, in his words, amid reporting that the president has been advised that potentially limited amount of strikes could help pressure Iran to reach a deal. Because at this point, the White House is maintaining that Iranian counter proposals have been insufficient, mainly over a lack of discussion over curbs on the country's nuclear program, though we know other big differences remain, including how Iran insists on full financial relief, payments for war damages, and that it has a role in controlling the Strait of Hormuz going forward. At this point, the White House is making clear that the threat of escalation is firmly on the table, but it's also probably worth mentioning that we heard from Iranian officials earlier this week who vowed to retaliate if the country is ultimately attacked again. At the moment, the White House is keeping up the economic pressure. Instead, yesterday, the Wall Street Journal reported that the U.S. had seized another Iranian-linked sanctioned oil tanker as it ramps up its efforts to crack down on the Iranian shadow fleet. John, Bloomberg News reported yesterday, according to people familiar with the matter, that as the Strait of Hormuz remains closed and the economic impacts compound, NATO is now looking at a potential mission to help secure the waterway if it isn't reopened by July. We should say, while several states have now indicated that they could be in favor of such mission, it doesn't have that unanimous support needed quite yet in order to deploy assets.
So it sounds like potentially NATO is going to come to the rescue in a sense. The president has been putting a lot of pressure on allies for months, Tyler. How soon potentially get some sort of concession from NATO or consensus from all the members to actually go to the Strait of Hormuz, potentially help the U.S. open it up?
Well, Annmarie, our reporting does indicate that July would be the deadline for these NATO member states to make some sort of decision on whether or not they will deploy assets to the Strait of Hormuz. As you well know, that does align with the annual NATO summit that is happening in Turkey this year. So perhaps that will be where we get a little bit more movement. This, of course, is a significant development since so far member states have been wary at best when it comes to President Trump's demands to help him secure the Strait of Hormuz. In fact, that has led to his threats that he could leave the alliance. Of course, easier said than done. We know that would take congressional approval, which at this point doesn't seem very likely. But it does highlight how the economic impacts have been compounding for these member states as they look to get more oil to the market. It's going to be something to watch because at the end of the day, we know that the White House has maintained that it doesn't need help with securing the strait, but we know that it is something that they would like to see.
Tyler Kendall with the latest in the nation's capital. Tyler, thank you. More from Tyler in the next hour. To build on this conversation, Catherine Thompson of the Cato Institute writing the US is teetering on a knife's edge of not only resumption of hostilities with Iran, but long-term entanglement in both this conflict and the region. Catherine joins us now for more. Catherine, welcome to the programme. Are we running out of options to maintain the status quo?
You know, I think we are. I think we're reaching that point. I don't think we're any closer to a deal than when the president was speaking about a week ago. And I think that, you know, in that time, particularly the foreign powers that are involved in this conversation, you know, on our side of these bilateral engagements, the UAE in particular has taken a more emboldened stance. This puts more foreign interests on our side of the table, where Iran is just contending with largely itself. And I think that this sets up a really dangerous dynamic going into conversations on a deal that now has a deadline of 2 to 3 days.
Well, Catherine, when it comes to this deal, I mean, the Wall Street Journal is reporting, but basically we all know that Iran's position on negotiations hasn't changed at all, as much as the vice president and the president said they want to make a deal. If their positions haven't changed, is the United States willing to give up some major concessions at the negotiating table, or do you think the president will actually take the strikes?
I mean, I tend to think that given what we've seen from the president so far, the strikes are very, very much the option that he's going to view as the best lever of pressure. The problem, as was pointed out in the previous segment, is the threat of Iranian retaliation. We know that that's the case. Of course, we know that, you know, the Iranians would plan to retaliate if they're attacked again. But the problem that this poses for the United States, who's in the midst of a munitions crisis, is that Iranian retaliation would likely come on U.S. bases and personnel throughout the rest of the region. That's going to require more of our most exquisite and expensive air defense platforms to support a defense of our own personnel should that retaliation come. And that's something that we can't afford to treat lightly on our side as a strategic consideration.
That's the retaliation. But what do you think the president will target if he's going to resume attacks?
That's hard to say, right? I mean, limited strikes, especially as was sort of outlined in the previous segment, could mean a lot of things. I mean, I don't know if that includes more energy infrastructure. I mean, I don't think it would include, leadership again or anything like that we saw towards the beginning of the war. But so it's hard to tell like what could be considered limited to sort of get the Iranians to the table that wouldn't, trigger, again, large scale retaliation that hurts our bases and our personnel in the region.
There seems to be two different negotiations going on, and Jonathan spoke about this earlier this week. There's a negotiations to open up the Strait of Hormuz, and then there's a real nuclear negotiation. When it comes to opening up the Strait of Hormuz, do you think the Trump administration has now convinced allies to come help?
I think that this is a tricky one, as you guys pointed out in the segment prior, right? NATO requires consensus to come to the table and to provide any support for out-of-area operations. The other, sticky point of this situation for the Trump administration is that basically the Trump administration spent the first year in office, berating the Europeans about doing out-of-area operations. They want the Europeans focused on conventional defense and deterrence of the continent, which is absolutely something that is needed to keep, NATO sustainable for the future. But that's in direct conflict with this ask of now NATO putting together an out-of-area operation, an out-of-area mission to go support the U.S. efforts in Iran. That's going to be a really, really heavy lift for consensus. And I think that we're quite far from it. I know we've got some time until the Ankara summit, but I think we're going to have a really hard time convincing some of those holdout NATO countries to come to our aid because politically it's very, very toxic for them.
Catherine, it's good to see you. Thanks for the input. Catherine Thompson there of the Cato Institute. If it goes on that long, and we're talking about the very back end of this year, NATO involvement's not a choice, it's necessary. And it's not about coming to anyone's aid. It's about getting something done that needs to be done.
It's about going almost to your own aid. But the president has been pushing them, and then remember, they immediately reject it, and he said, well, actually, we don't need your help. But the problem is the United States would need help, potentially, if they don't want to undertake this alone. But to your point, it's hurting their economies more. It's hurting the European economies and our allies' economies a lot more than, at the moment, the higher oil prices impacting the United States.
And there's always something to worry about. The words of Steve Orth of Federated yesterday on this programme, if it can't happen, it won't. Which is quite an interesting mantra. If it's that bad that it can't happen, then it won't.
Well, if that's the case, then potentially what we could see is the United States lift sanctions on Iranian crude, which the Iranian press says was part of the negotiating deal until they get to the actual table, which the White House is basically stomping down. Or we could potentially see the United States give concessions, maybe end the blockade in order to try to get the Strait of Hormuz opened.
Everyone's trying to deal with this in their own way. Did you see the headlines coming out of the UK? Pushing maybe some of the grocery stores, the supermarkets, to cap food prices. That's the push right now in places like the UK.
Well, the places like the UK are dealing with incredibly difficult moment because they're also dealing with a different energy complex than we are dealing with here in the United States. It's very challenging there when you look at how high petrol prices are.
Crude this morning, Brent down by about 2%. That's an improvement, but still trading near 110 at 109. Equity futures this morning near session highs up by 0.4%, heading into the big earnings report later on this afternoon when we hear from Nvidia. Before we get there, though, a couple of retail players in the mix, Target and TJX, worthy of attention. We'll get Target in just a moment. Full coverage of that. And this, up next, we'll catch up with Ines McFee of Oxford Economics as the AI backlash builds over the weekend and into this week. Some very clumsy comments coming from one particular bank, and we'll talk about that bank in just a moment. From New York City this morning, you're watching Bloomberg TV. Three-day losing streak on the S&P 500, the longest losing streak since the end of March. This morning, a bit of a bounce. We're up by some third of 1%, up 0.4% on the S&P 500. On the Nasdaq, up by 0.7, down almost 2% over the last 3 days on the S&P. That follows an 18% rally off the lows. Just a bit of context there. The rally has been really, really powerful. The correction, if we can even call it that, has been very, very small over the last 3 days. In the bond market, some major moves we need to talk about. New levels, a 30-year closing at the highest level since 2007. Yields down this morning by a basis point or two, 516.37. Front end of the curve gets interesting. From a political perspective, we're down about 3 basis points on twos. So the yield is trading above the policy rate over at the Federal Reserve, and we've talked about that repeatedly. Could this Fed really hike interest rates? That's difficult to internalise, at least before year-end, and we can spend some time on that. What's interesting about the political dimension going into this swearing-in ceremony on Friday of Kevin Warsh is just the president backing off a little bit from putting pressure from this institution to cut interest rates.
Twice this week, the president did that. In an interview at Fortune magazine, he conceded that maybe that the Fed's going to have to look at the figures after the war is concluded, basically giving a nod to the fact that he understands that with higher energy prices, that's going to maybe mean higher inflation. And then this to the Washington Examiner yesterday, quote, "I'm going to let him do what he wants to do. He's a very talented guy. He's going to be fine. He's going to do a good job." That was what the president said when this reporter asked if he thinks Kevin Warsh will deliver a rate cut.
Let's see if he sticks to the script this coming Friday at the White House when those two are standing together. Looking at energy this morning, we're backing away. We're down by 2% on Brent, around 109. WTI around 102. On our radar this morning, results from Nvidia due after the closing bell. The much-anticipated earnings set to signal the state of the AI economy, with investors awaiting the company's comments on ramping up chip production and fending off competition. Elsewhere, an important developing story. Samsung workers are set to strike after talks collapsed with its largest union, putting South Korea's economy and the global tech supply chain at risk. The company is the world's top memory chip maker and drives a quarter of the nation's exports. And finally, just dropping across the Bloomberg, Target shares rising in the pre-market, up by 0.5%. The retail giant's first quarter earnings topping estimates, delivering beats on comparable sales and gross margin. Target's forecast also coming in above expectations, calling for growth in net sales in every quarter this year.
So they've been working on a turnaround plan. It does seem to be that is working. Remember, Jonathan, they had 3 years of weak sales. So this is welcome news. I also wonder how much, when we hear from the executives, and we can get understanding of how much is this about Target's turnaround plan, or is it really also just a resilient U.S. consumer?
The environment versus execution. And I would say for that name, the problem for them hasn't been the environment, it's been execution. So you've got to give them a little bit of credit here. And we talked about this with regards to Walmart as well. Walmart's just executed so well as a company now over a series of years. It's difficult to look at this and say this is all about the backdrop, the environment, the backdrop for the consumer. We've heard about how the consumer feels about this economy. I'd give them a little bit of credit here. Target up by 2% at the pre-market.
Yeah, they're working on this turnaround plan. It actually is working. In the first quarter, they say they saw visits to stores were up 5%. But of course, it's a challenging environment then when you look at where they are in terms of the gap compared to the king, which is Walmart.
That's the economy right here, right now. Let's talk about the future U.S. economy. AI facing a massive week of backlash.
Today, we stand on this edge of another technological transformation. It will touch every profession, every classroom, every hospital. I know what many of you are feeling about that. I can hear you. There is a fear.
University graduates booing commencement speakers across the country when discussing the technology. Now, the Standard Chartered CEO walking back comments after saying AI could replace, quote, lower value human capital. The Oxford Economics CEO, McFee, pushing back on the negative AI narrative, writing the speed of adoption is critical and it's assumed to be orderly enough for new jobs to be created to absorb those lost. Innes joins us now for more. Innes, good morning. Good to see you.
Good morning.
Let's get into the pushback, the backlash we've got right now. What kind of labour market do you think we need to confront in the next several years?
Well, I think the near-term picture is not one of, mass unemployment and rising layoffs and things. That gets a lot of attention, but I think it's also important to note that if you look at, let's say, the information sector, you're also seeing higher hiring rates as well. So what that tells me is there's a lot of churn in the job market at the moment, but not a big net loss of jobs. For a lot of people, it's going to be about what are the skills that are needed to navigate this labour market over the next
What skills do you
months.
think will be needed? And do you think we face the same kind of thing that we had to face with globalisation, except this time it's white-collar workers and not blue-collar?
Well, I think when you look at AI adoption at the moment, what's actually being used at in the surveys, it is things like drafting, it's things like automating relatively simple tasks. And really, I think what will end up happening is that there's more emphasis on, kind of the more critical appraisal, the more insights, those sorts of factors. And that will be what's really critical for people to be able to demonstrate, because AI will be able to help with the sort of more day-to-day tasks.
What about the political economy? This is one area where I see the very far right, the Steve Bannons, and the very far lefts, like Senator Bernie Sanders, actually agree on what these companies should be doing because of the potential job losses they're going to mean for the economy.
Yeah. Well, I think, look, there's no doubt this is a huge structural change for the economy over the next few years. We've not yet seen the big productivity gains, but we are likely to see over the next couple of years, I think, a bit of a shift in that skills mix. And what we would expect is that you end up with, as you lower the prices of some of these tasks, actually demand goes up. It's what's called Stevens paradox. You start to see more demand coming through. But the phasing of these things, as ever with economics, we talk a lot about long and variable lags and things like that. Well, actually, in this context, that's going to be really important, because you're talking about, potentially a couple of years in the labour market where we have to navigate those shifting plates. So I think policy does have to play a role there.
That's political policy, but if we're seeing potentially shifting labour market and it's going to be bumpy, if we have higher unemployment because of AI, could Federal Reserve rate cuts or any central bank rate cuts actually solve that problem?
Well, I don't think it can solve the problem. As ever, monetary policy is going to be one of those things that actually just tries to help mitigate some of the impacts, offset some of them. But I don't think that's what we're seeing at the moment. We're seeing some churn. We eventually will see, AI adoption spread. We'll see the types of tasks that AI can help with sort of move up a little bit the value chain. And that will ultimately, maybe even mean a sort of disinflationary.
Tasks, do you think, to help current workers, or tasks to eliminate current workers?
So I think it'll be very much labour augmenting. It'll help current workers. I think that's the sort of thing that over time you'll see real wage gains because productivity rises.
You sound constructive.
Yeah.
Oh, yeah.
You really do. Yeah, do you get much pushback when you make this pitch?
Well, it does get, some people agree with me and then others violently disagree with me. I think that if you go back a couple of months and we had this kind of AI dystopia narrative really take hold, and this kind of idea that we would end up with, the labour share really falling and that, we're ultimately going to see a fall in demand. But the thing that I say is, name another technology where that has happened. We have not seen historically a technology that has led to kind of lower demand. We obviously see resources moving around the economy, and that can be painful, and there'll be a role for policy within that.
This is a big picture question. What do you think the Industrial Revolution would have looked like in the age of social media? What do you think that would have looked like? Can you imagine what the pushback would have been like to that?
Yeah, well, I think that's one of the issues here, isn't it? That you've got this narrative where, it's possible for really people to focus in on just one lens of it. And I think, what we try to do is step back and have a broader take on, some areas of the economy are going to face real disruption. Others are going to pick up and move in ways that we don't.
Ultimately, as you know, though, there's a sequencing problem. At least up front, all we see is the higher costs and the risks of job loss associated with this technology. What happens next, I don't know. You're constructive, and I hope you're right. But in the near term, we've got a bit of an inflation problem already. Does this big push contribute to it?
It does, but I think in ways that probably people don't really understand. A lot of people focus on the investment side and think, OK, that's pushing up demand. Remember, there's a big import story that's associated with that. So the net impact on the economy, in aggregate terms, is only a few tenths from the big investment boom. Where I think it is having an impact, particularly on the consumer basket, is that the push towards higher memory, higher value-add chips is actually sort of crowding out, particularly in an environment where we're seeing some supply constraints via the Middle East situation. That's where we're crowding out a little bit those lower-end chips, which are, of course, in lots of consumer goods. And we think that's probably going to add, at peak, something like 0.3 to core PCE over the next couple of quarters.
Where have you got inflation peaking? At what number?
So we've got 4% for headline PCE and sticking around 3 for a while in the core.
Can you cut with core around 3 if you're Kevin Warsh? Can you make that push?
Well, I think one of the things that he's been very clear on is the forward look, which I think is right, because remember, monetary policy is not going to affect much today. It's going to affect things in 2 years' time. His big idea, his big theme is that, of course, AI is going to be very disinflationary, and they need to look to that and respond to that. So I think that's the narrative that we'll see. It may wobble at times,
sure.
But I think in the near term we see them just staying pat. There's not much to be gained from cutting right now, just as you're seeing inflation peak.
He might find it difficult to get the rest of the committee on board with that view, looking ahead to the future.
That view might work in years' time, but what we just heard is that short term, it's going to be inflationary pressures, and it's very challenging to communicate that, I think, to give an excuse, a reason, whatever you think, to cut interest rates.
Ines, it's good to see you. Thanks for being here. Appreciate it. Thank you, sir. Ines McFee there of Oxford Economics. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Chinese President Xi Jinping stepping up his calls to end the war in Iran. Xi calling for a comprehensive ceasefire, saying, quote, restarting war is even more unacceptable. The comments coming as Xi hosts Russian President Vladimir Putin in Beijing. Target and Lowe's reporting first quarter earnings that beat Wall Street estimates. The business lead of digital payments company Block telling Lisa Abramowicz the consumer appears strong.
Things seem to be quite resilient right now. We're not seeing any of this stress or consumer sentiment or what's happening with oil prices flow through to actual behavior.
And we'll get more of a sign with earnings from retailers including TJX and Elf Beauty later today. Meta began notifying thousands of staff they're being laid off. The Facebook parent is cutting around 8,000 positions globally in a restructuring aimed, it says, at improving efficiency and cost cutting. That's your Bloomberg brief. John.
Hey, Vonnie, thank you. Thank you for the update. More from Vonnie in about 30 minutes' time. Up next on the programme, awaiting Nvidia's earnings test.
Nvidia will print a good number, but not a great number. They're supply constrained. They're sold out for the year, and once you're sold out, how do you beat expectations?
Up next, we'll catch up with Angelo Zino of CFRA from New York City. You're watching Bloomberg TV. Next up on the earnings front, we get TJX at 7:30 Eastern Time. About 15 minutes ago, we heard from Target better than expected, up in the pre-market. We'll stay focused on retail for you throughout this morning. Later on this afternoon, you will hear from Nvidia after the close. That's the headline act. The Federal Reserve minutes will be interesting. 2 p.m. Eastern Time. Remember that dissent, that hawkish dissent to the easing bias in the statement. All complicated stuff. Very vague, this easing bias in the Federal Reserve statement. But regardless, some pushback from FOMC officials. We'll see if we get more pushback in the minutes themselves. Look out for that later on this afternoon. Noteworthy, Bloomberg Intelligence came out with a survey recently on Kevin Warsh entering the Federal Reserve. More dovish than Powell is the headline here. Over half of our survey respondents thought that he would be more dovish than Powell, while just 9% said he would have a more hawkish bent. The survey from Bloomberg Intelligence, noteworthy.
Definitely noteworthy, and obviously that's because of all the rhetoric surrounding Kevin Warsh and his statements, especially when he was, you could say, auditioning for the job. But this president, who certainly wants to see lower interest rates, but as we said earlier today, the president seems to be giving him some breathing room, given the environment we are in, telling the Washington Examiner that, he's going to do the right thing, telling Fortune maybe he has to look at the figures after the war is over. It seems like Kevin Warsh, when it comes to the president's mind, is going to have some time to get his feet wet, and maybe that means we're not going to see an interest rate cut this year.
Here's the direct quote from the president. I'm going to let him do what he wants to do. He's a very talented guy. He's going to be fine. He's going to do a good job. The president of the United States on Kevin Warsh ahead of that swearing-in ceremony later on this week on Friday. If you're just joining us, welcome to the programme. Here's the state of things in financial markets. Equity futures firmer by 0.4% on the S&P, bouncing back from a 3-day losing streak, the longest daily losing streak since the end of March, which just tells you how great things have been on the bullish side over the last month to 6 weeks. On the Nasdaq, we're positive by 0.75% on Nasdaq futures. On the Russell, up by about 0.5%. Let's turn to the bond market. 2s, 10s, 30s. Yields shaping up as follows. Yields on a 30-year at the highest closing level going back to 2007 in yesterday's session. This morning pulling back just 2 basis points, 30s to 516. Twos still elevated around 4.1% on the 2-year, down this morning by some 3 basis points as well. More data through the week, of course, jobless claims coming up tomorrow morning. Quick check on crude, Brent and WTI pulling back a touch. Brent crude down to 108, a break of that level to the downside. We're down by 3%. Tension still building, blockade still in place, and when you speak to people about what's happening over there right now, we are running out of options to maintain the status quo.
That's right, because inventories are starting to be drawn down, and potentially in the next few weeks and months in certain parts of the world, they're going to hit tank bottoms, and then that's it. And then you're going to potentially see higher oil prices. I will say, with the market pulling back a little bit, you do see, it feels like, the bias and inclination of this president to really want to have a negotiation. He doesn't want to resume those strikes because earlier this week he told us that they were planned and he decided to call them off. Secondly, you're seeing reports here and there, some tankers, like a South Korean tanker earlier this morning, some tankers are able to get through.
Brent crude at 108. Watch this space. Later on this afternoon, the big one on the earnings front, under surveillance this morning, awaiting Nvidia's earnings test.
Nvidia will print a good number, but not a great number. The stock has been sort of underperforming the sector all year long. I think that will continue. Nvidia has grown so big and become so dominant that it's hard for it to sort of beat that. They're supply constrained. They're sold out for the year, and once you're sold out, how do you beat expectations?
So here's the latest this morning. Results from Nvidia due out after the closing bell, offering a fresh read on the durability of the AI boom. Angelo Zino of CFRA maintaining a strong buy and a 12-month price target of 270, writing, "This reflects our view of Nvidia's expanding total addressable market, penetration into edge devices and software opportunities." Angelo joins us now for more. Angelo, welcome to the program. I want to pick up on that line from a bear on this stock, the lone sell. He calls it an underperformer. We'll get into that in just a moment. But this line here, they're sold out for the year. And once you're sold out, how do you beat expectations? Angelo, what's your response to that?
Yeah, I mean, listen, I think, Jensen typically manages expectations extremely well, right? So I do think there is room for upside here. I think when you actually look at the $1 trillion backlog number that he provided back at GTC, expectations in terms of revenue here through the rest of this year and in calendar 27, we think there's actually, with potential upside as they offer, things like Grok and what have you to that pipeline, we actually think there's potentially 10 to 15% upside to the revenue number in calendar 27. Not as much maybe to calendar 26. Is the bar higher? Are the numbers significantly bigger than they have been in the past? Absolutely. But when you look at the valuation of this company, 19 times our 27 estimate, you don't necessarily need to blow the numbers out at this point anymore. What you need to do is to continue to show things being steady in nature. You need to potentially surprise maybe in certain aspects. Maybe you announce a major buyback or something along those lines, given the greater cash flow that you're going to have here over the next 2 years. But I don't necessarily think you need to significantly beat street expectations at this point anymore.
Angelo, this was the blockbuster name. The earnings were massive and people were having viewing parties. Remember that over the last few years?
Yeah.
Feels like the buzz has come off this stock just a little bit. And if you look at the underperformance relative to the sector, explosive moves in AMD, explosive moves in Intel. Why are the fun and games taking place elsewhere?
Yeah, I mean, so it's the bottlenecks, right? I mean, investors love to chase bottlenecks, and you've got bottlenecks really building all over the place. Whether it be memory, which has kind of been out there for a couple of quarters right now, and there is, we'll see what happens with the Samsung strike and what have you. But that continues to be a major bottleneck. Will continue to be a bottleneck. We think through at least the end of next year. CPUs. Optics, it will probably even be more supply constrained as we go into 2027. And even some of these power management component areas, like the onsemi's and even like the Texas Instruments and Analog Devices of the world. So you kind of think about, the bottlenecks out there. There's enormous pricing power and earnings, potential earnings uplift there. But as far as Nvidia is concerned, we typically don't look at it relative, at least anymore, to the semiconductor industry. We actually compare it more so to the broader S&P 500. And from that perspective, they continue to be an outperformer, given that this is more of an infrastructure play. And I think if you're an investor, you have to look at it relative to those expectations.
Angela, what about the Chinese competitors? Are they good enough right now for the Chinese government to keep Nvidia out?
Well, it's interesting with how the Chinese government is playing all this. I'd say right now it's definitely the priority of the Chinese government to build that local ecosystem as much as they can. I think if all you're going to do is potentially offer the H200 to China, they'll continue to push back on it. If for some reason you make things a little bit more enticing, I think that then you have conversations where ultimately you could potentially get Nvidia inside of China. But at this point in time, you're probably not going to get much out of that, and you're probably going to see the local Chinese government continue to emphasize their local players.
I was with the president in China, Jensen Huang, obviously on that trip. And at one point, Nvidia was talking about $50 billion they could be recouping from the Chinese market. Where are you going to put that number now, end of the year? Does it still remain zero?
At this point, yes. And maybe to John's original question in terms of where there could be upside expectations, especially in terms of the revenue numbers. Again, if there was the potential for that number to not be zero, and that again is our expectation here for the April quarter and July quarter, and probably for the street, that would provide a potential catalyst here for shares and upside to those revenue figures.
Angela, any pushback to the spending from their big customers at the moment that's noteworthy enough just to think about a little bit more in the coming quarters?
No, I'd say probably not here over the next couple of quarters. I mean, I think the one you always have to look out for is Meta at this point in time. That's the one where, they're spending so much, and you really need to see them somehow find a way to monetize that ecosystem and find some revenue attached to, outside of, just what they're doing internally. You need to find other revenue metrics. Otherwise, you could see the potential for them to maybe dial back a little bit in future years. But at this point in time, you kind of look at just what Alphabet said on their Q1 earnings call and the expectations, I'd say, from the other big cloud providers, the Microsofts and Amazons. I'd anticipate you continue to see higher numbers, even for the neo clouds themselves. I think you continue to see that upward trajectory at least through 2027.
Angela, it's good to see you. Angela Zino there of CFRA. Going into this earnings report after the closing bell, Nvidia used to be the big blockbuster story for earnings season. Just maybe a little bit of that glitter has just come off the stock, just a touch relative to the big explosive moves we've seen elsewhere in the sector. This headline noteworthy is coming out of the UK. According to a person familiar with the matter, the UK is to delay the planned fuel duty hike due in September. They're not alone, of course, the UK, in making these kind of considerations. Of course, the US is talking about maybe suspending the federal tax. That's a very different proposal, but ultimately, similar story. There's a lot of pressure on these governments when it comes to costs and fuel prices.
Exactly. The direction of travel is the same all around the world. How do we make sure we keep fuel prices affordable for a lot of people? And for some countries, it's even worse. In Asia Pacific, it's how do we make sure we can offer them the fuel they need, let alone the prices? But as we were talking about earlier, petrol prices in the United Kingdom are just so much higher because of the tax than they are, say, in the United States.
Well, let's draw a distinction, of course. The UK is talking about suspending a hike to taxes. Right. And America's talking about just suspending the taxes.
Yes.
Which is slightly different.
Yes, it is different. But again, direction of travel.
Yeah.
This is politically, really, for so many politicians, especially in America. Remember the Biden administration, how when gasoline that summer was $5 a gallon? Yeah, it's a tax every day, especially in a place where people are, besides London, where there's lots of trains. These are driving communities, and you see that tax every single day on the side of the road.
In the UK, inflation slightly softer than expected this morning. That's helping out the bond market, at least in the United Kingdom. Coming up next on the programme, we'll catch up with Mark Lehmann of Citizens Commercial Bank, Monica Guerra of Morgan Stanley, Christian Keller of Barclays, and Jennifer Bostjancic of Bloomberg Intelligence on Target. A better story from them this morning.
This is a global bond market that has a lower and lower appetite for duration.
We don't see too many factors that are going to pull Treasury yields significantly lower.
We don't expect interest rates to come down.
You do need inflation, at least on a monthly basis, slowing for the Fed to be comfortable cutting.
I don't for a minute see how the Fed can deliver rate cuts this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
We've got a small bounce this morning, live from New York City. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Your price action of scores look like this. Here's your bounce, up by a third of 1%, following 3 days of losses on the S&P 500. On the Nasdaq, up by 0.6. On a Russell, small caps, up by 0.4. In the bond market, new levels to look at. 2s, 10s, 30s. 2s, still north of 4%. 10s, still north of 460. 30s, still close to levels we haven't seen since 2007. 516.37. Yields coming in. That's the good news this morning. We're down 3 basis points on 2s, on 10s, down 3 also on 30s, down by 1 to 2. Your day ahead is looking like this, shaping up as follows. More retail earnings coming up a little bit later on this morning. You'll hear from TJX at 7:30 Eastern Time. That's 30 minutes away after the closing bell. A big report from Nvidia. Nvidia, the major earnings report of the day ahead.
That's going to be the catalyst for this entire market, as the semiconductor trade obviously has had a bang-buster year, not just Nvidia, as you've been talking about names like Intel and AMD, but really what we've seen when it comes to Nvidia is not just beating enough, but beating at such a high level, clearing this high bar. And really for the market, it's going to be either the green light to continue this semiconductor AI trade, or potentially it's going to offer a reason for pause for individuals who have been saying it's getting a little frothy, we've overdone it.
It's had a nice rally off the low, off by something like 30% from the March 30 low that we've all been talking about at the end of March. But it's nothing like the rally we've seen elsewhere on the semi-index. Elsewhere within that index, you've got explosive moves, 3x the size of what we've seen in Nvidia, in the likes of Intel, in the likes of AMD. That's going to be a story a little bit later. A story for here and now is the retail story. Target doing better in the pre-market, numbers better than expected, going into TJX in 28 minutes time, and had a Walmart a little bit later this week.
Yeah, so shares for Target have been up more than 25% this year, and we've been talking about what does this mean about the resilient health of the U.S. consumer, but you put it well. Actually, this has to do with Target, their turnaround story, and how desperately Target needed it as they're trying to catch up to Walmart. And this earnings report shows that it is working. And everyone is getting a little bit more optimistic between their turnaround plan and actually how much Target has risen, and also what they're doing in terms of just changes at the store. It seems to be working.
Target up in the pre-market by something like 2%. Also later on, we're also going to get Federal Reserve minutes. This is interesting. Bit of hawkish pushback coming from officials as Chairman Powell steps down as the chairman and Kevin Warsh steps in. And it's interesting that the president is just turning down the volume, dialing back the heat just a touch, going into the swearing-in ceremony on Friday with these comments to a reporter. I'm going to let him do what he wants to do. He's a talented guy, very talented. He's going to be fine. He's going to do a good job.
My question would be, is the president going to take this tone as well on Friday? And on Friday, is it just going to be a swearing in, or is he going to have an audience, and is he going to take questions? And then if he's asked a lot of questions about how he feels about interest rates, potentially, could this potentially change and we see a little bit more pressure on the new income?
As I said in the last hour, let's see if he sticks to the script a little bit later this week. Coming up this hour, we'll catch up with Mark Lehmann of Citizens Commercial Bank, with stocks looking to snap a 3-day losing streak. Monica Guerra of Morgan Stanley, with President Donald Trump threatening to resume strikes on Iran, and Christian Keller of Barclays on the growing backlash to AI. We begin this hour with stocks edging higher on the heels of Nvidia's earnings report. Mark Lehmann of Citizens Commercial Bank writing, it's not just a company print, it's a real-time read on AI demand and the health of the entire ecosystem. Mark joins us now for more. Mark, welcome to the programme. Let's get the health check. How is the health of the entire ecosystem?
It's definitely healthy, Jonathan. It's headlines every single day. Obviously, we're 3 days from the trial of the century, I guess, and it came and went. But it's still the most important story in the marketplace outside of oil. And we're going to learn a lot today.
Outside of markets, Mark, AI's got a big PR problem. You would have seen the booze over the weekend, the clumsy comments coming from a bank CEO that we've covered extensively in the last 24 hours. You and I have had this conversation. Is that becoming a bigger and bigger issue? And how do they address this?
You know, we did talk about it, and it does not seem to have abated at all. Like you said, it was the bank CEO. It was some graduation speeches. They do have a PR problem, and they've hired the best in the world, and that hasn't actually helped. I think, unfortunately, as my kids would say, it is what it is, in a way. I think there are some issues as it relates to messaging. There are some issues as it relates to what's going on in corporate America. But this freight train is moving as fast as possible, and actually it's accelerating, and it's not going to slow down.
It's the policy story, though, Mark, on the horizon. And maybe I'm thinking a little bit too further out, a year, 2 years into 2028 and the next general. If the public are booing and they're pushing back and they can't get the message on track. I just wonder when the policy story starts to become a stock market problem.
Well, I analogized it to what happened 4 and 8 and 10 years ago when we had Mark raise his hand in front of Congress and all the internet people raised their hands in front of Congress and begged them to regulate them. And I remember watching Orrin Hatch and other people talk about the internet as if they didn't understand it. And unfortunately, I think we're going to see deja vu all over again, and that we don't have Congress really understanding what is actually going on every single day in corporate America. And you're right, the messaging in the general is going to be really, really important. But think about that 2 years from now, 2.5 years from now, in the big election in 2028. We do have one, obviously, in the fall. What's going to happen in the next 2.5 years is going to be, we're going to look back and say, oh my God, we knew this was coming, but it's actually more than we even thought then.
Well, Mark,
so that's what's going to happen.
Forget regulation. What about just a massive tax on these companies? What's the impact of that on the stock market?
I don't see it. I think there's going to be local jurisdictions that obviously make some big moves on that. We saw it overseas in Europe, if you remember what they did with Google and some other things. We saw that in the EU. I just don't see that here in the States. I think it's a big messaging issue. I think it's a big issue as it relates to corporate America, but I just don't see the wherewithal for Congress and the federal government getting involved.
John mentioned the Standard Chartered CEO, very clumsy language, talking about AI and displacement of employees and basically to just use AI instead. How do you talk about it?
Yeah, I don't see it as just wholesale displacement of employees. What we're seeing is the empowerment of employees, and we're seeing the ability for people to just do more with the kind of tools that we're creating. Citizens, we have this reimagine the bank here, and we're showing use cases that are very, very powerful for people. I think it does question how many people you're going to need to do that. But I remember when I started on Wall Street a long time ago, I was the first person to get a BlackBerry. I was the first person to get emailed broadly. And it sounds so archaic right now. But boy, I taught a lot of people back then what it was like and what power it was and how to not be afraid of it. And I think we're seeing that here at Citizens. So this, oh my God, everyone's going to be home using AI for their career. I just don't see it. I see the empowerment more than I see the problems as it relates to total wholesale changes in employment.
Well, Mark, that's the important distinction, empowerment or replacement. The BlackBerry was to help you. It was to empower you. It wasn't to replace you. And when we talk about agentic AI, typically we're talking about replacement and not empowerment. Are we getting it wrong?
Well, I think, as I always say, always and never are rarely true. I think everybody being replaced because of agentic, I think, is unlikely. I think that empowerment is really important. And you're right, Jonathan. The BlackBerry seems so archaic and novel, but back then it didn't. I will also say, for the power of some of our young staff members and some of the people who really understand the power of this to really make important strides within our company and all companies around and show the power of it as opposed to the fear is really as important as anything.
I'm old school. I wish we never had the day where we started taking our work home with us, but that's another problem. Mark, let's talk about the opportunity. Nvidia reporting after the closing bell. I've mentioned this a few times in the last hour. This used to be the blockbuster earnings report. Still is to some extent. Largest company on the planet, of course, but it's lost some of its glitter, I think, over the last month or so, because within the rally in chips, the explosive moves have been elsewhere, Mark. What do you think's changing?
I think it is still the most important company in the world. It shows because it really does power. It's the fuel for the AI and fuel for corporate America right now. I think part of it is just the bigger they are a little bit is sort of the messaging here. We've talked a little bit about the broadening of the chip market and what Intel and AMD have done. As it relates to Intel, the stock may have doubled in the last few months, but it's still relative to that market cap. That's a one-day move in Nvidia. So I'm a little less worried that move is a Nvidia underperforming. I do think it's the most important company. The bigger story, I think, Jonathan, is what's going on with the big AI companies and the share that's going on, the jockeying between Anthropic, OpenAI, and the others. There's plenty of market cap and there's plenty of investment still going on. That, to me, is still the biggest story, and Nvidia is going to power all of them.
Follow the talent, Mark. I'm following the talent, and they seem to be going to one, not the other. What's gone wrong at OpenAI?
Well, I think like a lot of success stories. I think big management issues internally. Obviously, there's been some stories that we've all read about what's gone on inside OpenAI. Anthropic has been really mighty in the last few months. They did, I think, in terms of PR and in terms of their quality of their chips, their quality of their offering, they seem to have won. We saw that with the Iran war and some of the inner fighting that happened with the federal government. That news certainly has seemed to die down. Anthropic's done an incredible job, obviously, over the last year of their story, of their success, of their offering. It's second to none right now. I wouldn't count OpenAI out by any stretch. It's an enormous market. There's too many winners that we can mention right here. But yes, things are every single day we hear a different story. But Anthropic has definitely carried the last few months.
Mark, it's good to see you. Thanks for dropping by and catching up with us. Thank you, sir. Mark Lehmann there of Citizens Commercial Bank, heading into this earnings report later on after the close. Let's give an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. The European Union finalising the text of its long-delayed US trade deal after months of negotiations. The EU clearing a major hurdle to ratify the pact before President Donald Trump's threatened deadline to impose higher tariffs on autos July 4th. The World Health Organization convening a meeting of its emergency committee as it searches for vaccines to contain the widening Ebola outbreak. More than 500 suspected cases and 131 deaths have been reported in eastern Congo, while Uganda has confirmed 2 cases and 1 death. And Goldman Sachs is taking the lead role in the SpaceX IPO. Sources telling us here at Bloomberg. Morgan Stanley also listed as a lead bank. Elon Musk's company is seeking a valuation of more than $2 trillion. The filing is expected to be made public as soon as this afternoon. And that is your Bloomberg Brief. John.
Vonnie, thank you. It's a topic we've covered so many times. It's crazy how big these companies have got in private markets, and they're not alone. This has been a story of the last decade.
Massive, and everyone is excited to read this IPO prospectus. Potentially, we're going to get that today.
They're not alone. SpaceX and then maybe Anthropic, OpenAI, all in the mix over the next 12 months, the remainder of this year. Up next on the programme, threatening fresh strikes on Iran.
They come to the table, they're begging to make a deal. I hope we don't have to do the war, but we may have to give them another big hit.
Up next, we'll catch up with Monica Guerra of Morgan Stanley Wealth Management, live from New York City this morning. Good morning. We've had a 3-day losing run. We're looking to unwind some of that going into earnings from Nvidia later on this afternoon. Equity futures bouncing back by about 1/3% on the S&P, on the Nasdaq up by 0.6, on the Russell up by 0.4. If you turn to fixed income, we'll start with Treasuries. Yields closing at the highest level since 2007 at the very long end of the curve. 30s this morning down 2 basis points, 516.40 on 30s at the moment. I want to turn to the UK, where you see a big rally at the front end of the curve. The 2-year down by some 10 basis points. Earlier on this morning, inflation lower than expected in the United Kingdom, but they have still got a price problem, and the government's attempting to respond to that. So Keir Starmer, the British Prime Minister, noting just moments ago that they will be extending the fuel duty freeze due to the conflict in the Middle East.
It's still very expensive, though, even stopping that hike for when it comes to petrol prices. It's still incredibly challenging. I sent Guy Johnson a message asking how much is it right now. I remember when I lived there, it was more expensive in the United States, but actually how much is it right now? He says it's about 158p a liter. 50% of that is tax. He said in your language, $7.48 would be the price in the United States. So that would be the highest state gasoline we would see in the United States, higher than California.
A massive chunk of that is taxes.
How?
A massive chunk. And all we're talking about here is freezing an increase in the taxes. That's very, very different to just cutting the taxes.
And the conversation in the United States is we're going to cut the tax, not we're not going to extend it higher. The United Kingdom was actually, even at these current prices, we're planning to hike taxes more. This is why they have an incredibly difficult political problem.
That's the latest in the UK. Future stateside positive by about 1/3%. I want to turn to crude just briefly. Brent and WTI. Brent looking like this, still around 110 at the moment. Let's call it 108.60 at the moment this morning. We're down by about 2.4%. Under surveillance this morning, threatening fresh strikes on Iran.
So they called up. They had heard I made the decision. They said, sir, could you give us a couple of more days? I'm saying 2 or 3 days, maybe Friday, Saturday, Sunday, something, maybe early next week. I hope we don't have to do the war, but we may have to give them another big hit.
So here's the latest this morning. President Donald Trump warning of a return to hostilities in Iran, while Senate Republicans are signalling unease about continuing the war. Tyler Kendall has the latest. Hey, Tyler.
Hey, John. Well, last night we saw the Republican-led Senate advance a war powers resolution in a key procedural vote, marking the first time that this has happened amid a dozen or so attempts since the conflict began. Republican Senator Bill Cassidy of Louisiana was the latest Republican to cross party lines, vote with 3 other Republicans who had been in favor of this measure. Maybe not so surprising, since he just lost his primary election over the weekend after failing to secure President Trump's endorsement. We should say that this is largely symbolic. It's unclear if it will pass the full Senate, then it would need to pass the House, then it would end up on President Trump's desk, where he would very likely veto it, though it does mark a clear eroding of support when it comes to the conflict in Iran, as President Trump weighs additional military action. Just yesterday, he said that he will give Iran, quote, a limited amount of time to come to the negotiating table, amid reports that the president has been advised recently that a limited amount of strikes could pressure Iran to make a deal. We should mention that earlier this week, Iranian officials did say that they will harshly retaliate if the U.S. attacks again. But so far at this point, the White House has maintained that Iran's latest counter-proposals have been insufficient, mainly over a lack of discussion when it comes to potential curbs on the country's nuclear program. But, John, we know other differences still remain, including at least publicly, such as Iran's insistence on full financial relief, payments for war damages, and also that the country retain control over the Strait of Hormuz.
Tyler Kendall with the latest in the nation's capital. Tyler, thank you. Let's build on some of this. Monica Guerra of Morgan Stanley writing the following: the impact of the strait closure is showing up in economic data. It's likely to influence the midterm elections. Trump needs to find some off-ramps. Monica joins us now for more. Monica, welcome in. Good to see you.
Thanks for having me.
Good morning. Let's talk about the pressure here and start with the problem. Have we got an inflation problem in this country?
Yes, I would say so. You know, the latest print right at 3.8%. That is notable. We've been talking about inflation coming for such a long time now. It started with tariffs, didn't really show up. And then now with oil, that's the thing to tip us over the edge.
And look at how places like the UK are looking to remedy some of this. Maybe they're not going to put up taxes. Great. People need more than that. What kind of remedies will exist in the US ahead of those midterms?
And there's a limited playbook that they have. They could do, a federal tax, freeze or pause. They could cut. But that only comes in at about a less than 20% savings, right, on the actual price. So when you do something like that, you want to have a big impact, and you want to do it right before the election. So doing it now isn't the time. It has a very short window. You could also start doing some, adjustments to the SPR, the Strategic Petroleum Reserve. You could actually, release more supply. But again, that also has a finite window where there's about a month or 2 where you get that relief, and then your oil prices go back up. So when they take those measures, you essentially have to time it with the election.
Will Democrats vote for that, given the fact that this is going to hurt Republicans, higher gasoline prices?
I mean, as far as Democrats, voting for it, what's interesting about that is that they're looking to also get ahead on the affordability narrative. So that's what they have to balance. How challenging does this get in the next CPI print? What does that look like? So we have to look at the forward impact, because you wouldn't get implementation until a September or October time period. So there's still time. If it gets worse, then you get Democrats, I think, to the table.
Do you think all of this potentially is going to push the president to make different decisions in Iran than he otherwise would have, looking at dealing with the regime?
I think at this stage, you're looking at a very hemmed-in administration, meaning that the choices are limited, and it doesn't matter at this point how drastic inflation becomes over the long run, because you're dealing with the same issue. We don't have a clear plan for exit, and any plan that we have is going to take additional defense spending, right? Defense investment in infrastructure in order to keep the strait open. So that is a given. And so for us, it's how quickly can they put those resources to work, and how can we work with our neighbors? And that's where the NATO piece comes in.
You can see how difficult they're finding it to maintain the status quo here. Obviously, they want the pressure on Iran. They want them to breach storage capacity for that oil industry to have massive problems. But this is why we're seeing waivers here, waivers there, just to keep energy moving, to get it to where it needs to go, and it's getting harder and harder to maintain the status quo.
Yeah, the Treasury Secretary, basically, when he came in as the new Treasury Secretary, remember how much he talked about on this program that the Europeans are the ones that also need to help when it comes to sanctions on Russian crude, yet it's this Treasury Department that is extending a waiver for another 30 days for individuals to continue to buy Russian oil.
Monica, I wanted to talk about the Federal Reserve with you, if we can sort of carve out some time to do that. There's a swearing-in ceremony taking place on Friday with Kevin Warsh and the President. It's notable, Annmarie's talked about this the past few days, that it just appears the President's turning down the heat just a little bit on the institution as his guy walks in. What are you expecting from Kevin Warsh? What are you and the team looking for?
Well, for us, we think that he's going to continue to fulfill obligation just in the same way that, Powell would, maybe with different language. And I think that that's the important thing. I'm not our, Fed rate strategist, so I won't get into all the details. But as far as we're concerned, we think that we're going to continue to see normal operations and that the big focus right now is going to be on the labor market. Does inflation actually cause weakness in the consumer? Then you get maybe an opportunity for Warsh to act. And that's where you could see those cuts in 2027. So still a longer lead up to that, but we don't think there's going to be a huge, reshaking of the House right away, and that the temperature is going to die down so that the new chair can get settled, get a grasp on the current state of affairs, and then follow the data, follow the labor market as to the next steps.
But ultimately, do you think he's a hawk or a dove?
At this stage, we think that he's in I don't want to say if he's a hawk or a dove, okay? Let me just address that directly.
It's only because what we've heard from him, we've heard both Kevin Warshes. We've heard a hawk of years ago and a dove when he was auditioning.
But this is what's so interesting about it, is that you have the political pressure, right, and the desire to fulfill the president's mandate, right, and goal of having lower interest rate, but also keeping the entire monetary system on track. And so those two things sometimes are in competition. So if you can find a way to do that and satisfy, both masters, then you have a really successful outcome. And I think that that's what he's looking for. He's looking for those opportunities to not let things get too hot, right, while still being able to fulfill the president's agenda.
I think we all wish him the best of luck. Monica, it's good to see you. Thank you.
Good to see you too.
Monica Guerra of Morgan Stanley Wealth Management going into that swearing-in ceremony later on this week. That will take place on Friday between Kevin Warsh and the President of the United States. A lot of pressure on that institution at the moment. He wants to reform it. He wants to make some changes. I think a lot of people who follow that institution think those changes should be made, but the optics are going to be really difficult because some of the reforms, some of the changes, for instance, let's say PCE is not the right index for us anymore. We want to change that. OK, that is just going to look like he wants to change it because he wants to cut interest rates to please the person in the White House, even if that might not be the case.
Exactly. It's going to look like you're changing the goalpost just so you can get to the outcome that you want, because maybe there's been undue pressure on you to actually get this job. I will say, though, the Treasury Secretary has one point talked about maybe actually we should be targeting an inflation range, but said you cannot do that until you hit your 2% target, because this idea, you can't be changing the goalpost mid-game.
The good news this morning, yields pulling back by 2 or 3 basis points, back down to about 464 on 10s. Coming up next on the programme, we'll catch up with Christian Keller of Barclays on the growing backlash to AI across this nation. Live from New York City this morning. Good morning. You're watching Bloomberg TV. A better picture so far this morning, up by 1/3 on the S&P 500. The S&P advancing by 1/3 following a 3-day losing streak. On the S&P 500, the longest such losing streak going back to the end of March. Of course, over that period, only down by 2% compared to a much, much bigger rally over the last 6 to 8 weeks. On the Nasdaq, up by 0.7. The main event a little bit later. Nvidia after the closing bell. Before we get there, earnings from retailers across this country reporting, including Target in the pre-market, high by 1.4%. Better numbers from them a little bit earlier on this morning. We'll get numbers from TJX in just a moment. We'll bring those headlines to you. I want to turn to the bond market. Let's just sit on this for a moment. 2s, 10s and 30s, and we'll start with the long end of the curve. And then we'll talk about the relationship between the front end and the long end. The long end of the curve yesterday the highest closing level we've seen on a 30-year yield going back to 2007. We're seeing this worldwide. Germany, the highest level since 2011. More recently, in the last few weeks, the UK, the highest close since 1998. In Japan, the highest level on record. Lots of reasons for it. The energy shock driving inflation expectations. It's highlighting limited fiscal space in certain places, exposing leadership issues in others, the UK being one. They're not alone, of course, and increasing a lot of uncertainty about the outlook for interest rates. And it's the outlook for interest rates I want to spend some time on, and what the 2-year and Fed policy might mean further out along the curve, beyond 2s, out to 30s, and whether we could see a gap open up between the policy rate of the Federal Reserve and the very long end of the curve. So let me go back to that Bloomberg intelligence survey and what we might expect from Kevin Warsh. This is their takeaway. Over half of our survey respondents think that he will be more dovish than Chairman Powell, while just 9% said he would have a more hawkish bent. In addition to that, in this survey, they also expect a steeper curve, for Kevin Warsh to drive a steeper curve. And the bear steepener is the most widely held steepener view. So what does that mean? That means you get a sell-off driven by the long end of the curve. Why? Because if you get Kevin Warsh, who's excessively dovish, and attempts to force rate cuts when we don't need them, that dovish policy mistake could be seen with higher yields at the back end of the curve. I'm not saying that's happening right now. I'm just saying that's something to watch in the months to come.
What's so interesting about this Bloomberg Intelligence survey is that actually it's contrary to what we've seen in terms of market expectations. What we've seen is a lot of market expectations change direction, where the market is now pricing in potentially a hike at the end of this year, even though some analysts still have cuts priced in. What we've been seeing in terms of the inflation picture, because of higher fuel prices as well, a big key driver of that, individuals now saying he might have to hike, even though people think, well, no, we heard him be a little bit dovish in audition process. They think he's going to go in a dove. The president seems to be giving him room, I think, to do nothing for the rest of the year. This
bond market's looking for an anchor. And of course, if we address this and this being crude, maybe we can make some improvements to this picture. Right now, crude is lower by 2%. We're down to about 109 on Brent. WTI around 102. The blockade continues. The status quo has its own problems, and we're running out of options to maintain that status quo. That seems to be the takeaway from our program so far this morning.
Absolutely. When it comes to the crude picture, though, you are seeing stories that could potentially mean a little bit softer in terms of prices. One, you have like a South Korean tanker trying to go through the strait. If that gets through, that would be a very good sign. You have a report from Bloomberg yesterday, our colleagues, talking about the fact that NATO, if the war continues by July, are willing to potentially, if they're able to get unanimous consensus, willing potentially to go help the United States force the strait open. And then what are you seeing from OFAC and the Treasury Department? Anywhere they can find barrels, they're willing to keep them on when it comes to supply.
Brent crude, 109 this morning, and down by a little more than 2%. That's the price action cross asset. Let's get you some news. On our radar this morning, Target, Lowe's and TJX all reporting earnings. Target rising after posting its best sales results in some 4 years, while TJX also higher on stronger than expected guidance. Lowe's, on the other hand, facing pressure after failing to raise its outlook, citing housing market challenges. Elsewhere, Vice President J.D. Vance defending President Trump, saying he does not make his own stock moves.
The president doesn't sit at the Oval Office on his computer on his Robinhood account buying and selling stocks. That's absurd. He's not making these stock trades himself.
Vance adding that he and President Trump are both supporters of banning members of Congress from trading stocks. And finally, President Donald Trump threatening to resume strikes on Iran in a push for a deal to end the war.
They come to the table, they're begging to make a deal, because they're begging to make a deal. I hope we don't have to do the war, but we may have to give them another big hit. We may have to give them another big hit. I'm not sure yet.
The president warning attacks could come in the next 2 to 3 days.
So he gave a timeline, 2 to 3 days, maybe Friday, Saturday, Sunday, something maybe early next week, a limited period of time. That's the window the president is basically giving the Iranians. You heard J.D. Vance, the vice president, in the briefing room yesterday say they want to make a deal as well, reiterating what the president said. But then you have reporting from the Wall Street Journal and just obvious reporting coming out of Iran state media is that the position negotiations in the U.S. hasn't changed. And right now, you brought this great point up throughout the week. There's really two parallel conversations happening. One, the United States is having with its partners and the regime to just try to open up the Strait of Hormuz. Then the second is a long-term negotiation when it comes to nuclear.
Was that a news conference on a building site yesterday?
Yeah.
Is that what that was?
It was a news conference.
A briefing with reporters around the ballroom.
He wanted to show off the ballroom, so in front of the construction site. Also brought in photos. I believe he also told the chef at the White House to have breakfast available. I think like bacon, egg, and cheese sandwiches. Yeah, I saw photos of that. Not sure who took them, but I saw photos of that. And then, of course, once the president is done, any questions, he always takes questions, and then it becomes about anything the reporters want to ask.
The food looked pretty good. I'll put it that way. I saw some of the pictures. Let's talk about a big story developing in this country. Let's turn to tech. The backlash building against the rise of AI.
The rise of artificial intelligence is the next industrial revolution.
Today, we stand on this edge of another technological transformation. I know what many of you are feeling about that. I can hear you. There is a fear.
College graduates booing commencement speeches embracing artificial intelligence. The Standard Chartered CEO, Bill Winters, looking to explain after saying the technology could replace, quote, lower value human capital. Keller of Barclays remaining positive, writing the anxiety about machines replacing human workers has not played out. Despite the dramatic rise of automation, there has been no dramatic rise in unemployment. Christian joins us now for more. Christian, let's get into this. It's an important conversation. Do you think there's a big gap opening up between the narrative and the data?
Well, I think if we look at history, and you know, these are not entirely new developments. When we had big technologies, there's always the fear that would create a lot of unemployment. If you look at it over the past 80 years or so that we have data, you know, it just never played out. You know, it's, first of all, new technology automates, so it replaces jobs, but it also augments, and that often makes people more productive, and new jobs are being created. That is the story that we can document. You know, if you look at the occupation that we have now, since the 50s, every year there were new occupations people couldn't even think of beforehand. So that's why, at least in the immediate future, or even the midterm, until we get to that, maybe, you know, that singularity space where machines do everything, I think that is an overblown fear of mass unemployment from AI.
Christian, luckily you're at Barclays. If you're at Standard Chartered, we might be having a different conversation. Venkat would never use the kind of words that we used in the last 24 hours, but it's kind of awkward. These CEOs seem to be finding it really difficult to talk about this technology and how it will improve lives and not just replace jobs. Christian, what's the best approach, do you think, going forward to talk about what you think is on the horizon?
I think, first of all, it is about, you know, productivity increases. And that is what the market is betting on as well. And so far, if you look at research, a very, very large variation of forecasts. You know, there are some, including Nobel Prize laureates, say this is going to be negligible, 0.1 percentage point in labor productivity each year. There are other studies who are saying 3.5. So the question is, what is more likely? And what we've done recently is we looked at an additional angle. From just the AI, you know, that is being discussed right now, mainly digital, you know, a large language model. And what we are seeing is now that we are having, you know, physical AI, humanoid robotics. And we think that addition, that combination of the two, will make a huge difference because it increases the tasks that can be automated. And, you know, bear with me, you may think, well, that means more pressure on labor markets, but it also means that the productivity gains could be much higher. And we think that is a positive thing.
In your note, I want to pose this question to you. You say, is it hasta la vista moment for human workers? At some point, though, will we see firms have just a smaller footprint when it comes to employees?
Certain firms, yes. And in certain occupations, it will go down. But as I said, it's really about the new jobs that may be created that may happen from this. Think about it, the jobs we have today. Many of them, if you'd ask our grandparents, they couldn't have imagined, you know, that you would have these type of jobs that we have today. So I think that is in a way what typically is missed in the debate. And that is really it. And if you have an expansion of the production frontier, you know, it's hard to think that that's a negative thing. Now, I do believe that the tendency towards the income of an economy going towards capital rather than labor, that probably could increase. I mean, there's a lot of evidence for this. You could even have wages rise, but rise less than the overall economy grows. That means like the share that labor takes home versus the share that capital takes home can go down further. There are some issues with that. I think, they're about distributive policies, etc., taxing capital income. We're not there yet, but those can be solved. The underlying message is you increase the pie. And that, in principle, is a good thing for humans in general.
Yeah, Christian, that's what I wanted to pick up on. And I'm pleased you went there because we've been confronting those forces now for decades. The shift of income away from labour to capital. Can you walk us through, you just kind of touched on it just briefly, the kind of policy response you would anticipate as those forces pick up, if they pick up, in the next decade?
I think what you would see is, I think it's quite straightforward that ultimately if you say, look, capital is taking an increasing share of what the economy creates as income, you would try to have to tax that rather than labor. We have still systems across the Western world really that are very skewed towards taxing labor income. And that makes less and less sense if you have a world where, first of all, also many people, can benefit from it. I think what's important is that the capital income doesn't accrue only to very, very few people, but that is widespread. Then even people who may be seeing their labor income decrease, as long as they participate in the capital income improvements, that would then still be a net positive, even for those who are not maybe at the very top of that chain of where income goes.
Christian, what do you suppose that would mean for capitalism? Would that be a world with a bigger government, more services, more universal basic income? How do you see that playing out?
Look, there's always the end state, right? Where do you get at the final stage? And as I said, there's a lot of room to go. Where, how far, not only AI, but also what we are particularly talking about in our study, humanoid robotics, how far they go, in which stages they come. I believe in the short run that doesn't necessarily mean bigger government, but it means changing our taxation system. I think that seems very clear, that you need to modernize it to a world where it's no longer labor is the main source of income.
Christian, thoughtful stuff, and forgive me for getting to the end of history several decades down the road. This was fun. Thank you, sir. Christian Keller there of Barclays on a new important note from them. Their research has been fantastic on the future of the labour force with this technology.
That ending point, though, and what this means for the political sphere is very interesting, because this is going to be top of mind and into the midterm elections this year, but also really, as you mentioned earlier, for 2028. Bernie Sanders last year put out a note talking about how it means AI and all of this can mean 100 million job losses in the United States over the next decade. He wants a robot tax, and you're not just seeing it from him. It's also individuals on the right as well. This is one area of agreement.
Futures this morning up by a third of 1% on the S&P 500 with an update on stories worldwide with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. The UK government set to delay a planned hike on motor fuel taxes that was due to take effect in September. Prime Minister Keir Starmer says he is extending the freeze through the end of the year after a surge in costs since the Iran war. It's one of the most highly anticipated financing deals of the year. Sources telling us here at Bloomberg, banks are preparing to sell $49 billion worth of debt to back Paramount's takeover of Warner Brothers Discovery. In sports, the Knicks off to a strong start in the Eastern Conference Finals after storming back to win Game 1. They were down 22 points in the fourth quarter before locking down defensively and coming back to force overtime. Jalen Brunson led all scorers with 38 points. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you very much. 22 points, 8 minutes on the clock. Looks done and dusted. You know, if I was there, and this is bad, I know, I go to bed very early, so forgive me. If I was there, I would have left. I would have walked out of MSG, and that would have been a massive mistake.
I actually went to a Knicks game recently, and I left early because of the shift we have getting up. And thankfully, they were winning, and they were up, and it wasn't a big deal. But I would have totally regretted that. 7 minutes, 40 seconds on the clock, and you're down by 22 points, and you still win. Absolutely unbelievable. You know, I woke up in the middle of the night, and I checked the score, and we were losing, and I was just really upset. But then I woke up for good. Then I watched the whole fourth quarter on the way into work.
Crazy turnaround. Just unbelievable game. Up next on the programme, persistent consumer resilience.
Things seem to be quite resilient right now. We're not seeing any of this stress or consumer sentiment or what's happening with oil prices flow through to actual behavior.
Up next, we'll catch up with Jen Bartashis of Bloomberg Intelligence on the latest earnings this morning. Target out earlier and TJX too. Those two names in focus going into Walmart numbers later this week. we're doing better this morning, up by 1/3% on the S&P 500, higher by 0.6 on the Nasdaq, on the Russell, up by 0.5. Retail earnings from TJX, from Target have been good so far. We'll spend some time on that in just a moment. If you turn to the bond mod, we've had some real headwinds growing in the global bond market. 10-year yields up in 6 of the last 7 full trading days. Over that period, higher by around 25 basis points. We caught up with Barclays just yesterday, Ajay Rajadaksha, who said this: with debt rising faster than growth, worsening inflation profiles, no political will for fiscal reform, there is little reason to reach for the long end. He did not like this bond market at all.
Absolutely not. They don't want to touch it. And Barclays is even, some of their analysts are fearing that we can get to 5.5% on the 30-year potentially if this environment continues. A lot of this has to do with not just what's going on in the fiscal space already, where some of these governments are spending too much over the course of the years. What is happening right now when it comes to oil? How long can we live with 110 basically holding on to Brent? The fact of the matter is, maybe not that much longer when you think of NATO saying by July, we might have to also do something and go help the United States in the Strait of Hormuz because their economies are feeling it the worst.
Just on the bond market, that's Ajay's point. At this price, it doesn't get it done. He wants a yield closer to 5%, and right now we're around 464. And at times at the long end of the curve, particularly in places like Japan, the UK, it has just really felt unhinged. It feels like a bond market without an anchor. Will this be the anchor? Need a much bigger move than this. We're down 2% on Brent and on WTI this morning. Brent at 109, WTI around 102. Consumer squeeze continues. Response at the political level continues to build. It ain't enough. The pressure in the UK is the one to watch. They're freezing a fuel tax hike. They're also considering pushing supermarkets and grocery chains to cap food prices, which anyone who's closely followed economics and the history of economics knows that's not always a great idea.
Not always a great idea. And we saw that play out, remember, in the mayor race in New York, basically giving the current mayor, Mamdani, a little bit of a lesson on economics on how that actually does not work when you cap food prices. What I'm astonished with the United Kingdom, after Guy Johnson told me where petrol prices are right now, would mean north of $7 a gallon in the United States. How are they even considering the hike in September in the first place?
Let's talk about some of those retailers and the consumer squeeze. Under surveillance this morning, persistent consumer resilience.
Things seem to be quite resilient right now. Like we have seen an increase in spending at gas stations, but consumers seem to have absorbed that, and so we're not seeing any of this stress or consumer sentiment or what's happening with oil prices flow through to actual behavior. Despite some of the stresses and the headlines that you might read, things look pretty good.
So here's the latest this morning. Retail earnings ramping up with Target today. The retailer rising after posting its best comparable sales growth in 4 years. Jen Bartashis of Bloomberg Intelligence joins us now for more. Jen, welcome to the programme. We can talk about the backdrop, the consumer squeeze, the environment, Walmart on the horizon. Can we just spend some time on the turnaround at Target and execution? What do you think they're doing right at the moment?
Well, it really comes from a lot of investment that they've made in supply chain and efficiencies. And so when you think about it, although that's kind of the back end of the business, what it translates into is having the right things in the stores at the right times with shelves full. And that makes it easier for them to then run promotions and advertise and bring people back into the stores. And so I think a lot of the tactics that they've employed are turning out to drive some traffic growth, drive that improved result. But it's really stemming from those organizational and procedural changes that they're making at the heart of the organization.
What else do they need to do to catch up with competitors like Walmart?
Well, I think one of the things that happened with Target is, they need to stay true to who Target is. And so I think it's a dangerous path to try to chase Walmart and best Walmart at what Walmart does well. Instead, I think Target needs to get back to that sense of what is it that consumers really love about Target, or Target as people used to be excited about, and focus on those areas and building their brand with the people that care about those products. And that's the direction that we see the management team taking, which is pretty encouraging.
I love that you say that, because that's what me and my cousins used to call it growing up. But they had a fun makeup section and all this exciting stuff in the health wellness space. We used to call it Target. Is that what they're leaning into right now? Is that where they're seeing sales increase?
Well, a lot of their sales are coming from household essentials and from food, which is really not surprising considering that people have sort of retreated to those essentials. But areas that have sparked some growth lately, they've always been strong in beauty. Apparel sales are improving. Hard lines, which is some of the home decor type of items, those sales are improving. And those are the things that are at the core of Target essence. And so we're seeing that slowly turn. And again, that's helping support the results that we saw today.
Jen, you've seen Target, you've seen TJX. We get Walmart tomorrow. What are you expecting now?
For Walmart, they have been on a roll. They have been consistently pulling in more consumers into their ecosphere and holding them and capturing a greater share of their wallet and spending. The current backdrop is just very conducive for anybody playing in the value space. That includes TJX this morning. That includes Target. That includes Walmart. To continue to have the opportunity to gain share of wallet. And so. There's no reason to think that Walmart isn't also benefiting from those macro trends. We're expecting to see consistent growth from Walmart that we've seen in recent quarters.
They're having a good year, that's for sure. Jen, it's good to see you. Jen Bostjancic there of Bloomberg Intelligence. The turnaround continues over at Target.
It continues. And actually, I was in a Target recently, and one thing that you do if you have the app, you can see what you want and what exact aisle it is on. Or you can have them deliver it to your car. You go into that exact aisle. You know where it is. You don't have to waste time looking around. That's sort of the push they're doing when it comes to technology that's actually been helping this company.
Walmart, the next stop. Target this morning, up by 1.4%. The next stop for this market, of course, Fed minutes later on this afternoon, then a big earnings report after the closing bell. You might have heard that Nvidia reports a little bit later on today. Into all of that, equity futures on the S&P 500 building and bouncing by about 1/3 of 1% on the S&P, and advance on the Nasdaq as well, following a 3-day run of losses on the benchmark on the S&P. This morning, the Nasdaq higher by 0.6. To turn to fixed income, lots of jitters, nerves about what's developing at the long end of the yield curve. 30s this morning coming back in by a single basis point, 516.48. 10s at 464. This move in crude won't hurt. Brent and WTI coming back down. WTI and Brent down by some 2% this morning. Brent crude at about 109. Coming up in the third hour of Bloomberg Surveillance, we'll catch up with David Kelly of JP Morgan Asset Management, Meghan Welch of Brown Gibbons Lang and Company, Kathy Bostjancic of Nationwide, and Ben Reitzes of Melius Research from New York City. You're watching Bloomberg TV.
This is not simply an AI-driven rally. It's a broad rally.
What we are seeing is the AI momentum continues to move forward.
Were it not for AI, this would be a very, very different story.
You asked me to pick a side right now, I would not own equities.
Just because you're not at 2000 bubble territory doesn't mean you're not in a bubble.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Interesting to hear those comments from Ajay Rajadaksha over at Barclays. This is someone who was super bullish at the end of March when this market hit a new low, had a big rally off the back of that. Now, he doesn't like stocks, and he doesn't like bonds either. And the situation in the Middle East has got him a little bit nervous.
When he came on originally and the Strait of Hormuz was closed, and he was doubling down on equities and saying, we're going to see the S&P 500 take off. This train is going to continue because the AI trade. My eyes were coming out of my head because what I was talking to individuals on the ground and commodity experts were talking about how dire the issue was going to be for energy. And that's Ajay that showed up yesterday.
The power of earnings, and that's why he was bullish initially. It's not that he didn't think the situation in the Middle East didn't matter. He just didn't think it mattered yet. He thinks it matters now, with bonds breaking out and yields breaking out to new highs more recently. If you're just joining into the programme, welcome to the programme, live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts with these scores right here. Equity futures on the S&P 500 bouncing back by 1/3 of 1%, following a 3-day losing streak, which amounted to a loss of about 2% on the benchmark. On the Nasdaq, up by 0.6, going into that major weighting for both the S&P and the Nasdaq, the #1 rating on these stock indexes. We'll hear from Nvidia after the close. In the bond market, new levels on 30s, the highest close we've seen on a 30-year yield going back to 2007 this morning, down 2 basis points. 30s at 515 85. After the close, Nvidia. Before we get there, Fed minutes. Now, typically, yeah, this can be a little bit snoozy. This gets more interesting given the pushback we've seen on the committee over the last few weeks.
Right, when it comes to those dissents, it's going to be interesting to go through some of these minutes. Also, ahead of a new Fed chair arriving, getting sworn in the end of this week on Friday with the President of the United States at the White House. Also politically very different. Haven't seen that happen, Jonathan, since the late 1980s with Alan Greenspan.
Fed minutes coming up a little bit later on this afternoon. Nvidia after the close. Coming up this hour, we'll catch up with David Kelly of JP Morgan Asset Management, with stocks looking to snap their longest slide since March. Meghan Welch of Brown Gibbons Lang on the next phase of defence investing. And Ben Reitzes of Melius Research expecting a beat from Nvidia. We begin this hour with stocks bouncing back and bond yields near historic highs. David Kelly of JP Morgan Asset Management writing, it's a positive environment for US fixed income, international equities and some alternatives. A little more difficult for US stocks after 3 blockbuster years. David joins us now for more. David, welcome to the show.
It's good to see you.
Let's start with the bond market call.
Yeah.
Is it getting more interesting for you then? 10s, 30s, this back up in yields?
Yes, but I wouldn't overplay this. I think the Strait of Hormuz issue is going on longer than it should, because I think people have, maybe in the administration, have been wrong-footed by the fact that gasoline prices haven't gone up that much. I mean, I know we're at $4.55 this morning, but it's still not as high as it was in 2022. I don't think they realize that the reason for that is because we came into this year with bulging inventories, and that gave us a few months to work down those inventories. But now every week from here on out that the Strait stays closed, that inventory situation is going to get worse and worse and worse. And that's eventually they're going to cry uncle. And I think that, I think when you look at markets, it's important not to look at where we are today, but realize the administration will have no choice but to come to a deal with Iran by which oil flows from Iran and other Gulf states out of the Strait of Hormuz. There is no other solution to this. Now, we need to obviously we need to do something about the nuclear program. We tried to do that before, but ultimately that's where we're headed.
So you think this administration blinks first, not the regime?
Yes, because the Iranians know that they've got an asymmetric threat. They can, with very little effort, stop oil coming out of the Gulf, and they know that every week that gasoline prices goes up, it's more pressure on the U.S. administration, more pressure on the global economy. So they'll have to. And the deal is, I mean, the Iranians don't have all the cards, but the deal is we're going to separate the Strait of Hormuz issue from the nuclear issue. We're going to get back to something like the agreement that we had, the
JCPOA.
Yeah, exactly. We'll get back to
something else.
Go back to. Yeah, of course I'm going to say it's better, but ultimately it's how do you control their nuclear program? What do you have to do to get them to back off? But that has to be separated from the Strait of Hormuz, because the Iranians, that's going to be their bottom line, and eventually the administration will blink.
As an investor then, do you really care what the deal looks like? Do you just assume the energy story is going to be flowing by the end of the summer and just look past it?
There are plenty of risks out here, but that should be your base case, and that's right. And that's why I'm not too freaked out about the increase in long-term rates. I'm not that freaked out about seeing higher energy or long-term inflation priced into tips, because I just think a lot of this is a slight overreaction to clearly a dire situation in the Gulf right now, but one that really, it's only going to end one way.
So, David, just take that a step further. In markets at the moment, and the way things have been priced, in markets where we're pricing more hawkish policy responses, places like Europe, you taking advantage of maybe what you believe is a dislocation?
Possibly. I mean, I think the Europeans and the British and the ECB have been sensible so far in not reacting to what is essentially an oil supply shock in raising rates. I hope they are sensible enough to keep with that, but maybe not. They are, by nature, more hawkish than the Federal Reserve. What I don't believe is, I do not believe this Federal Reserve is going to raise rates. I think it's kind of interesting. The new Fed chair, he's going to have his work cut out just to stop the rest of the committee trying to push for higher rates. So any rate cut is off the cards. But I think the Europeans probably are more likely to be hawkish for longer than the US, and that does ultimately mean, I think, the gap between US rates and international rates closes and the dollar comes down, although most of that may not occur till 2027.
I know there's a mandate issue here. There's a dual mandate in the States. There's a single mandate in European central banks. But it's kind of odd we're talking about a more hawkish policy response in Europe when the profile for growth is so much worse relative to the US.
Because they see the potential for inflation getting embedded through the labour market, and that is just what will not happen here. I mean, if you look at the wage growth that we saw in that April employment report, it was up a little bit from March, but it is close to the lowest level we've seen in 5 years. Despite this really tight labour market, the truth is American workers are so dispirited, they won't ask for a wage increase. And if you don't ask for a wage increase, you cannot get wage price spirals going. It just won't last.
I often ask you about this. Is there a union difference as well?
Oh, yeah.
Is that factor important?
Absolutely. I mean, part of its union is because less than 6% of the private sector in the United States is in a union. And obviously it's much higher than that in Europe and in the UK. But there are also institutional things. I mean, in a lot of Europe, there are cost of living adjustments automatically priced in to wage agreements because of increases in inflation. And that doesn't happen in the United States either. So, I think there's some argument that, wage growth might be a little stickier in Europe, but Europe does not need to collapse demand. I mean, their demand is weak enough as in Europe and the UK. They've got plenty of other problems to worry about.
David, where does this leave the Fed then? You don't think they're hiking in this environment?
No, I think they're going to work on their golf game for the rest of the year. What they're not going to do is they're not going to cut in June. And the only question is, I used to think the only question is it going to be 12-0 or 11-1? 11-1 would be fascinating because there has not been a single instance in all the history of the Federal Reserve of the Fed chair voting against the majority of the FOMC. And I don't think it's going to happen now. So I think it's probably going to be 12-0. The other question is there any Fed, particularly regional bank president, who might say, you know what, we should hike. I'm going to dissent in favor of a hike. At some stage in the next few months, you might see that. But overall, the majority of the FOMC is going to keep their heads down, try to get through 2026, see how the situation in the Gulf finally resolves itself, and then see what the trajectory in the economy and inflation is at that point.
Has the risk increased, though, for a Fed chair to dissent?
It has, because we'll have to see how Kevin Warsh approaches this, because he clearly gave the president the impression that he might be open to cutting rates. I don't actually think he is. But he gave him that impression. And so the question is, how does he now square this? But my guess is, he's a smart guy. His job now, the job of the Fed chair is to try and find a consensus in the committee. It was interesting Jay Powell talked about that a little bit in his last press conference. That's really the job of the Fed chair. Well, you're not going to form a consensus or build that consensus over the years if you start out by dissenting from all your colleagues on a rate cut.
We've redefined dovishness. It's just getting this Fed to do nothing through the summer.
Right.
That's the big goal now.
And I think one thing that Kevin Warsh has on his side is that the environment has changed from when he was auditioning and interviewing and in front of the Senate hearing. Now there is a higher inflation picture. Gas prices are higher. And seemingly the president does understand that based off these two interviews this week.
Crude's not at 60 anymore. It's got triple digits, and that's a massive change. Let's finish by talking about equities. Massive bounce from the end of March. Huge rally in the semis. Nvidia after the close a little bit later. Is your attention elsewhere beyond the US?
I mean, it is interesting, the gap between the rest of the world is still beating the US in equities this year, but it's only down to about 200 basis points, so it's by less. I still want to overweight the rest of the world. I do think the rest of the world is cheaper than the US, but there's still this institutional bias in favor of the US equity market going higher. Things like the movement, money pouring into 401ks, stock buybacks, the difficulty getting money out because of capital gains. All this gives a natural upward bias to the US equity market, which is not present elsewhere. So I wouldn't bet against this US market either.
Changing that bias? We've seen some headwinds. I'm thinking about supply from some major IPOs. I'm thinking about less buybacks at some of the hyperscalers because they're investing so much money into their businesses.
A little bit, but then it's at some stage over the next few weeks, if I'm right and the administration blinks and there's some agreement, that's another reason to pop the champagne corks.
Culturally, it's so different. You travel the country, and you know what it's like in Europe. In Europe, there's a bias to worry. Absolutely. In America, there's a bias to invest and to buy.
Absolutely.
You just can't change the culture.
And I spent the first 20 years of my life in Europe, and Europeans look at the glass and it's half empty, and Americans look at the glass and it's 3/4 full.
And not much has changed.
No.
From an investing perspective, anyway. David, it's good to see you. Thank you, sir.
Great to be here.
David Kelly there of JP Morgan Asset Management. Equity futures right now in the S&P firmer by 1/3% on the S&P 500 with an update on stories elsewhere this morning. Let's get to your Bloomberg brief with Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. A busy morning of retail earnings. Target rising in the pre-market after it posted its best sales result in 4 years. TJX also higher on stronger than expected guidance. Lowe's facing pressure, though, after failing to raise its outlook, citing housing market challenges. Live Golf starting to lay the groundwork for a potential US bankruptcy filing. Sources telling us here at Bloomberg the league is currently looking for money after its main backer, the Saudi Public Investment Fund, pulled its funding. Global chip supply may be at risk. Talks between Samsung and its largest labour union collapsing ahead of a planned strike at the world's biggest memory chip maker. Workers are set to proceed with the stoppage tomorrow. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next on the programme, the morning calls. Plus, we'll catch up with Meghan Welch of Brown Gibbons Lang & Company on the new era for investing in defence. That conversation just around the corner, live from New York City this morning. Good morning.
Think about it, the jobs we have today. If you'd ask our grandparents, they couldn't have imagined, that you would have these type of jobs that we have today. If you have an expansion of the production frontier, it's hard to think that that's a negative thing. The underlying message is you increase the pie. And that, in principle, is a good thing for humans in general.
That was Christian Keller of Barclays joining the programme a little bit earlier on this morning. Given the backlash we've seen to AI, the boos over the weekend to commencement speeches at graduation ceremonies, it's quite something, and the very clumsy communication from one particular bank in focus over in the UK in the last couple of days. Equity futures right now, the S&P 500 firmer by 0.4%. We're bouncing back from a three-day losing streak on the S&P, the longest daily stretch going back to the end of March. On the Nasdaq, up by 0.7, going into the heavyweight earnings report after the close. Nvidia just around the corner. In the bond market, some better news. 2s, 10s and 30s. If you're on this side of the trade, of course. Yields are down by 3 basis points on 10s, 463.53. 30s, the highest close since 07. Multi-decade highs on yields at the long end of the curve. Not just stateside, worldwide. 5:15 this morning.
Interesting what David Kelly said. It reminds me kind of what Steve Off told us yesterday. If it's so bad, it won't happen. Meaning the U.S. is going to have to blink and potentially make sure that they do something at the negotiating table, some sort of concession, just to get the oil flowing again. That means end the blockade and getting to some sort of agreement to get the Strait open.
Well, let's get you an update on what's happening with crude as well. Brent and WTI. Bit of a pullback today on Brent crude. Crude down by some 2% throughout most of this morning. 2.6% lower now at 108.40. I've repeated this throughout this morning. The takeaway from all of our conversations, this can't continue. And we're running out of options to maintain the so-called status quo.
Well, that's what's really challenging, and a lot of our guests continue to point to this, and David was great on it, this glut that we had going into this crisis. Now, guess what? All those reserves are being depleted, stockpiles are being drawn down, and this is where it can get the next few weeks and months incredibly challenging, especially for Asia Pacific and Europe.
Brent crude at 108. That's the price action. Let's get you some morning calls. First up, Piper Sandler cutting its price target on Home Depot and keeping an overweight rating, saying there's pent-up demand in the home improvement space. Your second call from Stifel, raising its price target on CrowdStrike to 660, saying the company's partners are bullish on growth expectations for the fiscal year. And finally, Wells Fargo trimming its price target on Meta to 765. The analysts still expecting improving cloud revenues and rising backlogs. The stock is up this morning by 0.25%. Let's talk about the situation in the Middle East. The US threatening to resume strikes on Iran if a deal to end the war isn't reached in the coming days. Iran warning today it would retaliate beyond the Middle East if the US or Israel restarts attacks. Joining us now for the latest on the ground is Becca Wasser of Bloomberg Economics. Becca, welcome to the programme. I often ask this question, what phase are we in? What phase do you think we're in right now? And how sustainable do you think it is?
Well, right now, the phase that we are in with the Iran war is a phase of purgatory. We're neither here nor there. We're not in open conflict, but there's also no peace either. And this phase is largely focusing on the Strait of Hormuz at the moment, where you've seen President Trump trying to take various actions, whether that is Project Freedom, the blockade, trying to break the logjam in the strait and have it reopen. But right now, I think, we are in sort of a nacho phase where there's not a chance Hormuz opens, which means there's either going to need to be some type of negotiated settlement, which means that President Trump is probably going to need to accept some concessions, or resume strikes, and neither of those are very good options.
Becca, Annmarie was talking about the administration just looking for barrels here, there and everywhere. Sanction waivers here, sanction waivers there. It does raise the question just how sustainable the current status quo actually is before we run out of these reserves. And these reserves have been aggressively drawn down since the end of February, the start of March. Becca, how sustainable do you think things are?
I don't think they're very sustainable. And That's just on the economic dimension. If you look at the military dimension, you have had U.S. forces in the Middle East deployed for several months, right? There was a strong buildup prior to the start of hostilities over 3 months ago. So there's also a U.S. readiness problem from the military standpoint, in addition to the global economic squeeze that we are feeling because of the situation in the Strait. And I don't think that's going to change anytime soon, in part because Iran knows that it has leverage now, and it is going to try and exert that control wherever possible. Even if there is a gradual easing in the Strait of Hormuz, they're still going to saber rattle on occasion to remind the United States and the global economy that they do have that leverage.
Becca, appreciate your time. Thanks for joining us. Becca Wasser there of Bloomberg Economics. We've had this question being asked a few times on this programme. What do we hit first? Tank bottoms in the West or tank tops in Iran? The blockade continues.
Blockade continues, and I think the Iranians are actually used to this and can find ways to squirrel away any barrel of oil. What is interesting, though, is the structural shift that might happen for this. Like Becca was just talking about, the Iranians know they have this leverage. Do you think they're just going to go away with the toll now and not actually use it? Of course not.
That's the latest on the Middle East. Let's build on this and talk about the defence sector. Meghan Welch of Brown Gibbons Lang & Company writing, the next phase of defence investing is less about the weapon itself and more about the systems that keep forces prepared and operational every single day. Meghan joins us here in New York. Meghan, good morning. Good to see you.
Good morning. Thanks for having me.
Let's take that quote and just build on it a little bit more. What do you mean by that particular quote?
Yeah, I mean, I think so. The defense industry has become a real area of investment for both the public markets and the private markets. The critical funding tailwinds behind it, the increased defense spending across the board has really attracted investors. And it's less about like the F-35 or some of these large platforms. It's more about all the sustainment that goes around it. So all of these systems, the support services, et cetera, are areas where investors are seeing opportunities to be able to get access to the defense market without any of the risk associated with, programmatic delays or cost overruns.
When I often think of this particular sector, I think of very, very high barriers to entry. Do you have to bear that in mind when you think about some of these companies in private markets?
I mean, it just depends where in the sector you're looking to invest, but not really. I mean, there are ways to play defense and get access to this market without having to, go through multi-year training or multi-year investments and testing. So again, the services, the logistics are part of the O&M budget in the defense industry in the U.S. And that's an area that's pretty insulated from any kind of continuing resolution or defense budgetary disputes between the politics.
What about things like Project Maven at the DoD? Has that changed potentially what companies are going to be working with the Defense Department that aren't traditional or normal that we think of?
Yeah, absolutely. The defense procurement has been broken for decades. That is very well known, both in the defense industry, but also in Silicon Valley, the Valley of Death. There's been a real push in this administration. You're laughing, I'm sure you've heard it 100 times, but there's a real push in this administration to change that up. It is a very large ship to turn with a very small rudder. To Trump and Hexet's credit, they're doing a good job trying to do things like the Gauntlet program or Project Maven, but trying to get more dual-use technologies and commercial-use technologies into defense to accelerate where we are from a warfighter readiness perspective. It's just really hard because fundamentally the defense market itself is structured around annual funding budgets that don't really have multi-year procurement signals. And it's hard for commercial industry guys to be able to understand what does that look like in 3 to 5 years and how can I actually forecast my sales and forecast my supply chain to meet that.
One of the big stories at the DoD right now, and actually what we've heard from the likes of executives at Palantir, is what's going on in Iran will be the first really AI-driven war. When I think of that, I think of Anthropic, because obviously they're using Anthropic on their systems. At the same time, the Pentagon is saying it's a supply chain risk. How does that impact potentially what companies work with Anthropic and the DoD when you think about investing?
So AI is definitely playing a huge role, not only in things like Palantir, but also in robotics and unmanned systems. It's going to be a force multiplier and a real force structure going forward. TBD kind of how it plays out in terms of how Anthropic works with the DoD directly. There's a lot of risk associated with that from a cybersecurity basis and from a technology risk basis, but we're seeing more and more AI-enabled capabilities that allow us to increase our force structure and our presence that we wouldn't be able to do just fundamentally with boots on the ground.
What about the political risk of regulatory concerns? Because a lot of people don't like the idea of autonomous weapons.
Yeah, I mean, so autonomous weapons are they're very much going to be the future of the warfare, right? So we saw what happened in Ukraine. When we look at where we're competing against Russia and China, we just don't have the bodies, the boots on the ground to be able to match them one for one. And it also takes a lot of risk out of loss of life, right? So you think about having the unmanned wingmen, right? So not having as many airmen in the air and having the risk of loss of life. There's a lot of benefits to unmanned systems, not just out of force multiplier, but to be able to take some of the risk away from loss of life.
Do you see the investment really only and what's potentially going on in this space, the advancements in the United States or elsewhere? Because I see a lot of work that Ukraine has done when it comes to drone warfare.
Yeah, Ukraine has been fantastic. It's been a great case study for the future of warfare. I jokingly say it's kind of like what the machine gun did for World War I. It's been a total change in how we go to war going forward. We are never going to go to war like we did in Iraq and Afghanistan. But yes, absolutely. And internationally, there's been more defense spending and defense investments that we've ever seen in the last 20 years, really since the peace dividend of the 90s. And Ukraine's been the leading, case study of that, of how to be able to use defense technology to be able to have it in a modern warfare conflict.
It's driven massive change in Europe and attitudes to investing in defense.
Yeah. Absolutely. Investing in defense in Europe, but also in terms of the technology, Ukrainians are the ones that know how to strike down these Shahadi drones. We're sometimes using Patriot missiles to do it. Right. They have their own anti-drone systems that are much cheaper.
And now going to the Ukrainians to learn some of those lessons. Meghan, appreciate your time this morning.
Yeah,
Thank
absolutely.
you. Meghan Welch there of Brown Gibbons Lang and Company on the future of defence investment. If you're just joining us, welcome. Later on, of course, Fed Minutes. And we'll get those earnings you're all waiting for from Nvidia in the here and now as we count you down to the opening bell, about 1 hour and 5 minutes away. Equity futures near session highs by 0.4%, higher by 0.75% on the Nasdaq 100. Up next, we'll catch up with Kathy Bostjancic of Nationwide with bond yields near historic highs and the Fed firmly on the sidelines, multi-decade highs on 30-year yields this week. In the last month, we've seen that in the UK, Germany, and all-time highs at the long end of the Japanese curve. More on that in just a moment. From New York City, you're watching Bloomberg TV. Equities doing better than OK, bouncing back by 0.5%. The last 3 days down about 2%. So this is your bounce, just eating into those losses so far this morning. On the Nasdaq up by 0.8%. Had some earnings earlier on this morning. Target, heard from Lowe's, TJX. Retailers going into Walmart tomorrow. Target up by 2% in the pre-market, adding to a gain of about 30% on the year so far. The numbers from them this morning, the best sales growth in 4 years. The turnaround looks to be going quite well. Some evidence of it this morning.
Looks to be going quite well. We heard from our own analysts about what Target is doing right, which is leaning into why people like to go there, things that people like to buy when they are at Target, and also just upgrading some of the technology around it. I was talking about earlier, I used this app over the weekend before I went to China. I had some stuff to go buy. It told me exactly what shelf and row an aisle all of the goods were going to be at. Made the whole thing a lot more easy.
Super helpful. That's the story at the single name level. Let's turn to the bond market. 2s, 10s and 30s. Lots of attention at the very long end of the yield curve on the 30-year yield, given the close yesterday, the highest we've seen in multiple decades, going back to 2007. Yields this morning down by a basis point, 516.50. on 30 so far this morning. Later on this afternoon, the attention will switch to the front end of the curve when we get these Federal Reserve minutes following that hawkish descent to the language in the statement at the Fed's last meeting. From there, there's just been a chorus of pushback to the easing bias from several Fed officials, so look out for that in the minutes a little bit later this afternoon. 2s around 4.1% ahead of Kevin Warsh's signing-in ceremony a little bit later this week.
I think everyone's excited for that signing-in ceremony because they want to see how the president talks about Kevin Warsh in the signing-in ceremony, because it's going to be at the White House. It's not going to be at the Federal Reserve. It is going to be at the White House for the first time, I believe, since 1987 it was, with Alan Greenspan. And basically, the president this week, in a number of interviews, 2 of them notably, in Fortune and Washington Examiner, pushed back on this idea that he wants to see Kevin Warsh come in and cut interest rates. Said he's going to do the right thing. Also gave a nod to what's going on in the war and the inflation picture and said maybe he'll have to look at the figures after the conflict is over.
The swearing-in ceremony later on this week. Let's talk about the Treasury market. Big move in yields, still holding near multi-decade highs due to inflation fears and some fiscal concerns building worldwide. Ira Jersey of Bloomberg Intelligence joins us now for more. Ira, welcome to the programme. I want to spend some time on your survey on Kevin Warsh a little bit later, but let's just start with the moves we've seen at the long end of the curve, not just in the US, in the UK, in Germany, in Japan. What do you think the dominant driver, Ira, is right now?
Yeah, it is what you just mentioned, John. It's that fiscal issues in a lot of the developed markets, right? And the U.S. is part of this, but we're not actually the worst actor when it comes to this. It's really Japan and the U.K. that have been, some of the bigger drivers, and they've been pushing. So it's a tail wagging the dog type of moves where you see these 10, 15 basis point moves in Japan or the U.K., and then you'll see 5 to 7 basis points in the U.S. and parts of Europe. So it is a global bond sell-off. This isn't unique just to the U.S., but obviously you take note when, as you said, we had a closing high on the 30-year yield yesterday for the worst in almost 20 years.
Ira, when you and I were first talking about these issues more than a decade ago, we were talking about the anchors of JGBs, of the bond market. Those anchors have gone. What is the anchor of the global bond market now?
Yeah, so for the long end of the yield curve, I think it has to be the end user and the real investor, and a lot of those, there still is a lot of demand for long duration assets globally, because we do have a very large, what we call liability driven investors. So these are pension funds, insurance companies, life insurance companies in particular at that long end of the curve. And they tend to like yields in US dollars at around 5%, 5.25%. So I think one of the big questions here is, do we hold these types of levels? Do they come in and continue to buy and add duration in treasuries instead of doing what they have been doing, which is buying corporates at super tight spreads, but at yields that are 6-ish% or maybe even a little less? And so I think we're at the levels where risk management says, okay, look, yes, the U.S. has a pretty bad fiscal situation, but realistically, they're probably not going to default. It's more of an issue of, do they have to inflate their way out of this debt? I don't want to call it a crisis, but this massive amount of debt that the U.S. holds, and it's an area where pension funds and insurance companies can say, okay, look, we'll buy at 5.25% now or soon, and that has to be what arrests the market. I don't think the monetary authorities like the Fed are going to come in and be buying the long end just because we've sold off 40 basis points in the middle of a war.
Ira, your point on credit is important. Now, I hear this all the time. I'll say spreads are really tight. What do you like about corporates? They'll say all-in yield. But if all-in yield is high and credit spreads are tight, then the bigger bulk of that component of that spread, that interest rate, is the risk-free rate. And if I can get a risk-free, why wouldn't I just buy the risk-free rate if it makes up a bigger component of the overall all-in yield? What's the appetite for credit versus risk-free? Unless you think there is a risk there. And maybe that's the change, that people consider the sovereign to be increasingly more riskier than maybe some of these corporate credits at the moment.
Yeah, I don't think that that's really the case. Like when I've talked to a lot of investors, it is how do we take the risk and do we they're not really worried about the U.S. In particular, the U.S. defaulting, right? It's more will the U.S. have to run higher inflation, and if they run higher inflation, does that mean that we're going to have systemically higher bond yields? So that's the bigger concern for a lot of investors, not the U.S. not paying its bills. But to your point, I think that's the point I was trying to make is, as a percentage of all-in yield, Treasury yields now are much higher, and so that makes it more attractive to these liability-driven investors.
We're talking about the longer end of the curve. We started by talking about what the move we've seen in 30s, Ira. Let's tighten things up and talk about the front end of the curve and the policy rate. The survey you and the team did at Bloomberg Intelligence, Kevin Warsh is a known entity, but how he'll interpret this particular role at this particular time is largely unknown. Ira, what are investors saying in your survey about what they're expecting from Kevin Warsh relative to what we saw from Chairman Powell?
Yes, so a pretty big majority of investors, about 2/3 of them, have suggested that Kevin Warsh is going to be more dovish than Jay Powell. Now, that's not obvious to some people, including us, because in the past he has been a little bit more, I don't want to say middle of the road, but he's been willing to make some hawkish comments when the rest of the committee has been dovish. And just the opposite might be true as well, where he might say, okay, look, we need to cut interest rates because of reasons that I espouse, not necessarily the president, even though the rest of the committee is somewhat more reluctant to cut interest rates. I think the big takeaway from the, which I think was interesting from that survey, was that most respondents think, like up to 84%, I think the number was, if I recall well, that they could change the policy framework during his term. So that would say, maybe we go away from the PCE being the target. Maybe we go away from the Fed funds rate being the monetary target and we use SOFR or something else. And it could be that they get rid of or change the summary of economic projections pretty well in terms of how they express forward guidance. So all of those things are something that is probably somewhat more realistic than the Federal Reserve cutting interest rates in June or July amid inflation with when Kevin Warsh finally takes office.
There's a lot on the table, that's for sure, for the incoming Fed chair. Ira, it's good to see you. Thank you, sir. Ira Jersey there of Bloomberg on a number of issues across the yield curve and in the fixed income space at the moment. Kathy Bostjancic of Nationwide writing, rising inflation should embolden more of the FOMC to formally adopt a neutral bias in the next policy meeting. While new Fed chair Kevin Warsh is likely to prefer lower rates over time, we expect an extended pause. Kathy joins us now for more. Kathy, welcome back to the programme. Just describe that June meeting, what you think it's going to look like alongside the SEP, because they've got to put out some forecasts as well.
Yeah, good morning, John. It certainly will be an interesting one, no doubt. But I think what you're seeing is the momentum, as you mentioned, is more Fed officials are saying, why do we have an easing bias in the face of high inflation, which, we think inflation, CPI is bound to go over 4% in April. So really hard to hold on to that. Moving to a neutral bias or risk, neutral assessment makes a lot more sense. So I think that should be rather easy. It will be interesting to see the updated SEP forecast, because in the ones in March, there were really no updates. In fact, if anything, if I remember correctly, they pushed up GDP growth a bit, which is surprising. So how do they recalibrate growth? Where do they see the risk there? How high do they see inflation by year end? And not just headline, I think core. I think what the bond market's really trying to suss out right now, is this just energy and is it just headline and somewhat short term, or is it possibly bleeding over to core inflation?
Kathy, when it comes to potentially a dovish Kevin Warsh, is it dovish that the market expects rate cuts, or just that he convinces the committee to keep the easing bias?
So I think it's tough right now. I think he's inclined to argue for lower rates over time. I think he would really even find it difficult now to come in and argue that the Fed should, in the near term, be cutting rates. Maybe, possibly, there's an opening by year end. And I say that if we really see some resolution in the Middle East and gasoline prices come down and all the other energy prices, and particularly if core inflation is somewhere around 2.5%, that could give a little opening. He does prefer these trimmed mean inflation measures, depending what they look like from the Dallas Fed or Cleveland. Maybe that gives some opening to cut rates. But I think in the near term, even he will be kind of in more of a neutral stance at this point.
Like we saw from the Federal Reserve when it comes to the potential impact on inflation from tariffs, when it comes to the energy hit, shouldn't they be looking through this?
I think yes, and I think largely they do, although there's risk that, as I said, it spills over to core and other non-energy measures, and also inflation expectations. Right, that is kind of the golden goalpost in a sense for the Fed. If inflation expectations become dislodged, they worry that inflation, not just this year but even next year, could run higher, right? It becomes a self-fulfilling prophecy. But what we know is with break-even rates for inflation in the bond market, they're very correlated with oil prices and energy. So Our view is if you get some relief there, probably inflation expectations and even long-term bond yields come off the highs that we've seen here.
We're seeing some of that this morning, at least so far. Kathy, thank you. Kathy Bostjancic there of Nationwide on this bond market sell-off in the last few weeks. This morning, yields lower by 2 basis points at the long end, 5.16, 5.17 on 30s. Let's give an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Samsung and Google are unveiling new smart glasses with a launch planned later this year. Built with Warby Parker and Gentle Monster, the devices let users interact with Gemini by voice. Features include directions, calls, translations, and camera-based queries. Goldman Sachs taking the lead role in the SpaceX IPO. Sources telling us here at Bloomberg Morgan Stanley is also listed as a lead bank. Elon Musk's company is looking to raise as much as $75 billion and is seeking a valuation of more than $2 trillion. The Northeast heat wave continuing for a third straight day. Heat alerts in places in Boston, New York City and Philadelphia. Over a dozen daily record highs were set yesterday. A cold front, though, coming in by tomorrow will take temperatures down by 30 to 40 degrees. And that is your Bloomberg Brief. John.
Vonnie, thank you for the update. Not that last one, but thank you in general terms. Up next on the programme, setting you up for the day ahead. Plus, we'll touch base with Ben Reises of Melius Research with Nvidia earnings on deck. We'll also speak to Ed Ludlow, who spoke to Jensen recently, what he's expecting from these earnings after the closing bell.
Jensen typically manages expectations extremely well, right? So I do think there is room for upside here. What you need to do is to continue to show things being steady in nature. You need to potentially surprise maybe in certain aspects. I don't necessarily think you need to significantly beat street expectations.
That was Angelo Zino of CFRA going into that big earnings report after the closing bell. Nvidia just around the corner as we count you down to that opening bell. That's not the only thing we're watching today. Here's your trading diary at 11 a.m. Eastern Time. The President speaking at the US Coast Guard Academy. Look out for that. Another commencement address. I imagine AI might not get a mention in this one.
Well, I'm hoping that his team tells him the second you AI, be careful how you talk about it, because Mr. President, you might get booed.
Yeah, 2 p.m. Federal Reserve minutes. Look out for that. After the market close, we'll get those earnings from Nvidia. Looking ahead to tomorrow, earnings from Walmart, another round of jobless claims and PMI data to look forward to as well. On Friday, Kevin Warsh swearing in as Fed chair, the one to watch heading into the weekend. Equity futures right now, the S&P 500 firmer by 0.4%, a bounce on the Nasdaq as well. On the Nasdaq 100, higher by 0.75% as we await Nvidia earnings for a read on the outlook for AI. Bloomberg's Ed Ludlow joins us for more. Ed, welcome to the program, buddy. You caught up with Jensen recently. What was the read-through on the business at the moment?
Yeah, the same that it has been for some time, which is that demand is vastly outpacing the industry's ability to supply, not just Nvidia's. And there is a real beat and raise expectation with an Nvidia print. Like, no one's going to really focus on the quarter gone. They will want some guidance on the future. So top line growth of 80%, EPS growth 85%, is impressive if they're able to deliver in that environment, some upside to that. But the thing that still needs to be reconciled for so many people is China. It needs to be reconciled, John, because over a period of January through present day, the commentary from Jensen Huang and Nvidia and the commentary from the president and the outcome of that trip to China has been inconsistent.
Does it really matter, though, Ed? Given that we know it doesn't make up any kind of big proportion of the underlying earnings from that company, does it matter?
Such a great question. It's psychological for lots of people, right? The base case assumption right now is there is zero revenues coming from China. And, Nvidia has talked about the idea that they see it as a $50 billion per year opportunity. There was a time where China, not just for consumer electronics, smartphone, PC, data center as well, it was the absolutely most critical end market. The capital expenditure story of the hyperscalers in the United States and in the Western world has really changed that beyond the restriction of being able to do business with China. But still people want to know. And, the thing is that Jensen Huang positions himself in the center of that story. And what needs to be reconciled is in March, he said they were ramping up supply chain so they could sell to China. And of course, you saw what the president said on Air Force One last Friday, I believe. It's inconsistent. So I'm just saying on the sell side, at least, their checklist has that in their questions.
It's a point well made. I'd appreciate it. Looking forward to the programme. Ed Ludlow coming up a little bit later on Bloomberg Technology alongside Caroline Hyde. Nvidia this morning, firmer by close to 2%. Ben Rices of Melius Research with a buy rating on Nvidia and a 380 price target, writing, we expect a strong report with a meaningful beat and a raise. Ben joins us now for more. Ben, good morning. Good to see you.
Good morning. Great to be here.
Thank you for being here, sir. You've been dreaming of Jensen, according to your note, apparently. So tell us more. What was in the dream?
Well, I probably had PTSD from the stock underperforming for most of the year, at least the SMH, and by tens of points underperformance of the SMH this year. And I feel like there's a catch-up ready to be done here with Nvidia because their earnings are accelerating. And I do feel that the stock is priced as if they're going to have a meaningful deceleration. And I don't see it as meaningful as the stock is discounting. I think that it's trading probably under 20 times the real earnings power here by quite a bit. So I think that they need to reassure investors they can grow at least in line, if not better than CapEx at the hyperscalers. And I think they can do that.
Why has it lagged? Why have names like Intel and AMD had these explosive moves? And Nvidia, which has done well off the lows from March, I think up by something like 30%, but just nothing near the other parts of the market. What's been going on?
Well, when you're this big at Nvidia, 5 trillion plus, it's really hard to move money around. I kind of make a joke. You have to, if it was Europe, you'd have to put France on top of England, and it takes a little while. And when you're smaller, under $1 trillion, let's say, it's a lot easier to move capital around. And there's also been these acute shortages. So it's sort of like whack-a-mole in AI to the upside, where there's a certain shortage and then you go after that, and then another shortage, you go after that, and you go after that, and it's violent. So NVIDIA becomes a source of cash to invest in these acute shortages like semis, like memory, or pick your other optical, et cetera. So actually what happens is NVIDIA becomes a source of cash and then it underperforms. And then a night like tonight might be a catalyst for people to go, hey, wait a second, these guys actually have a pretty good business model, kind of know what they're doing, and they're going to grow pretty well. So maybe we should put a little more money back into the main horse that's driving this whole train. But I think NVIDIA is just fine, and I think it's natural to decelerate, but they still have much higher growth prospects than the stock is discounting, and eventually that works itself out.
Ed touched on it when it comes to the Chinese market. In your dream, does Beijing open up for Jensen?
No, it's a bonus. I think that the China thing is actually not a big deal tonight. I think nobody's expecting him to say he's going to sell in China. It would have been nice. It would have been nice. But the street doesn't want to put a great multiple on China either, because it's in, it's out. You don't know who the next president's going to be. You don't know one thing to the next with China. So I actually don't think it's that big a deal. I don't think anybody's expecting it. And it might come up tonight, but it's not something that we're going to put back in our model. It would be nice to have it, though. But I think the more important thing is the CapEx trend with the major hyperscalers and being able to at least grow in line with that. This year, CapEx among the major clouds is going to double. No one thought that going in. And if it can stay at like a 40% CAGR and these guys grow in line with that, these guys are going to do really well.
You say it's nice to have. Down the road, will China be need to have, must have?
It's potentially. I mean, it would be nice if the American technology stack ruled over there. I don't know how to say it nicer, but I just take it.
You sound like David Sachs when he was at the White House.
David says a lot of things that make sense, in my opinion. But it would be better if it was an American technology stack, I think, for the world. However, I do sympathize with some of the concerns that folks have. But I think that it's a race. And you have to understand that we have these hyperscalers here that have tons of wallet. And they have more wallet, actually, than the Chinese for now. And that's a plenty to really go expand this market. And labor's the TAM. Labor's trillions, and I think that there's a lot to go around, and China will have their share, and we'll have ours, and I think we're still well ahead. But
China has an entire government that subsidizes them and pushes them that we don't really have.
Yeah, right now, actually, we put out a piece today. The biggest risk, in our opinion, is backlash here. I don't want to get into the political merits, but in terms of a stock where you have to, we really, in China, the great thing that they have going for them on their AI business is the government's going to just go unabated. And culturally, from what I read and see and talking to people, that there's a little bit more optimism about AI. Hey, let's embrace it and try to make our jobs better, that kind of thing, and use it for productivity. And we need to promote that here if stocks are going to continue to work.
The message is just not good. What do they need to change? We spent the morning on this. The message coming from some of these companies. What's the right message?
The right message, I still I want to make sure I say the right thing here. You never know who's listening. The right message probably is this technology is not going to stop, so we have to invest in it, and you have to embrace it. There's never been a better time to start a company, never been a better time to learn the technology and become that person in your office that can be the most productive, and that's what the message needs to be, and that it's going to free up time to do other jobs, other things to expand. There's going to be a boom in leisure, in medicine, and many things. But I think that there needs to be more AI optimism. And then with the data centers, there's sometimes misinformation. There's the ability to recycle water. There's an ability to put power production behind the meter using natural gas or some other fuel to actually make it so consumers in the local area don't feel a pinch and actually can even get subsidized. So we need to do a better job marketing these messages and change the narrative and not let it be a political touch point that we blame because we need an excuse.
It's become one, that's for sure. Ben, it's good to see you. Thank you, buddy.
Great to see you.
Thank you. Ben Wright is there of Melius Research. Coming up tomorrow, Peter Chia of Academy Securities, the BNY CFO, Dermot McDonough and David Lovitz of JP Morgan Asset Management from New York City this morning. Good morning. This was Bloomberg Surveillance.